morning. It is 9 a.m. here in New York City on this Friday morning. This is Yahoo Finance Live. I'm Julie Hemming with Diane Kinghall in for Brad Smith today. And here are three things that you need to know this morning. The United Auto Workers making history as the union goes on strike simultaneously against the big three automakers. 13,000 workers downing their tools after leaders failed to reach agreement on a new contract. The strike initially targeting specific plants at GM, Ford, and Stellantis. The impact on the U.S. economy is unclear, but estimated to be in the billions of dollars. The pain extends to the White House and President Biden, who has long touted himself as the most pro-union president in history. Arm's rally continues after its blockbuster IPO. The SoftBank-backed business was valued at around $60 billion at its Nasdaq Open. The chip designer's public listing is the most high-profile IPO the Nasdaq has seen since 2021's boom, which cycled into something of a bust the following year. SoftBank still controls about 90% of the British company. We'll speak with a tech analyst, Richard Windsor, on why that is SoftBank, takes most of the value and if it opens the door for a tech IPO comeback. And the move higher in oil prices continues. Crude trading around 10-month highs, boosted this morning by stronger data out of the world's second biggest economy. China's retail sales surprising to the upside, growing 4.6% in August from a year earlier. Industrial production also increasing by 4.5% on an annual basis. The push higher in oil has largely been supported by expectations of tighter supply. The IEA this week warning that OPEC Plus cuts will tighten the oil market sharply in the fourth quarter.
Well, the United Auto Workers makes history as the union goes on strike simultaneously against the big three automakers. The strike initially targeting specific plants of GM, Ford, and Stellantis in order to, quote, cause confusion, as said by UAW President Shawn Fain. Here to break this all down for us is Yahoo Finance's Pras Subramanian and Rick Newman. So, Pras, hi, Rick. Let's start with you about what's the latest. We knew this was a possibility coming into this, and, you know, the clock was ticking yesterday, right up until this morning. So what's the latest?
Yeah, you know, the union said that they were going to do this stand-up style strike, and they followed through. They did that last night at midnight. Basically, like you said, striking at three different plants. Now, I want to note these three plants are very specific. So it's GM's Wentzville, Missouri plant, which builds their mid-size trucks and full-size vans. Ford's Michigan Assembly, which is what they noted final assembly and paint only. That's what they said about that plant. It's Ranger mid-size pickups and Bronco SUVs.
Right?
Yes. And the Stellantis Toledo Assembly plant, which is the Jeep Wrangler and Gladiator. So these are specific products that are pretty popular amongst those big three customers. So they targeted them specifically. That's what they're going to go to right now, around 13,000 employees, as you said, but only a small percentage of the 146,000-ish employees that UAW has under its roster. So very targeted here. They want to do this right now. A couple of the automakers put out statements saying that they're kind of not surprised, but they're disappointed, basically saying the UAW wouldn't budge from their initially high demand, so they're kind of disappointed there. A Ford source tells me that if they were to accept all the UAW demands, it would double their labor costs, so they're kind of very concerned about that. But, you know, the UAW argues, hey, our cause is righteous here. The CEOs are pulling $20 million a year. Ford, GM, up the profit guidance. So there's a lot of back and forth there. Both sides feel that they're in the right. And this battle, I think, and you'll ask Rick, I don't think it's anywhere close to being over.
Well, before we get to that, just one more thing about tactics that is quite interesting to me here with these targeted plants. As you mentioned, these three plants being affected thus far do make popular models, but they don't make the most popular models, which sort of leaves the UAW with another bargaining chip or another lever, if you will. Like, if they affect production of, say, the F-150, then that ratchets up the pressure, right?
Right. I think they picked models that potentially are popular, but not the huge holy grails of the big GM, say a full-size pickup, Ford's full-size pickups as well. Stellantis Ram brand, right? So they didn't do that yet. But I think that the automakers on the other side can actually do something on their end, and they can lock out the workers. That's another option. Hey, you know what? Let's get the end game now.
Right.
Lock them all out and see what happens. That's an option that's being, not that I've heard that from automakers, but it's been talked about by analysts.
So, Rick, what do you make of all this? We've had this kind of labor uprising that we've seen in different industries, and now here hitting the auto sector. What do we think about this trend that we're seeing here?
Well, first of all, I want to hit on something Pras just mentioned. We're only getting started here. This strike could easily go on for a month or two, and I've talked with some analysts who say 60 days seems to be the point, the pain point for both sides, because that's about how much inventory the Detroit automakers have. It varies by model, but that's an average. And that's also 60 days is also the point at which the UAW strike fund would start to run out, and they would not have any money to pay the striking workers anymore. So that means I think this is going to get a lot worse. And I think this is going to be a real test of how Americans actually feel about this. On one hand, if this goes on for more than a month, let's say, it will probably lead to higher prices, not just for the Detroit models, but if the Detroit models, SUVs, and if we ever get to pickups, do start to run scarce, then that means all the other brands will be able to raise their prices as well. And we were just starting to get back to normal in the car market. I mean, we had all the COVID disruptions, supply chain disruptions, semiconductor shortage. We've talked about this many times. Car prices skyrocketed, including used prices, because people couldn't get new cars. And that has all sort of been slowly normalizing. And now we have this. So it depends on how long this strike lasts. But my bet is this is going to last for a considerable time and is going to force Americans to pick a side, basically. I mean, are they going to say, yeah, this is fine because workers need to flex their muscles these days? Or are they going to say, we're sick of high car prices. Go back to work and make more cars. I really don't know how it's going to shake out, and I think it's really interesting to watch this.
And of course, there's a political element, which is your bread and butter. I mean, Sinn Féin really, with a populist message here, to your point, that sounds good, probably to a lot of Americans. Given the other strikes that we have seen over the past couple of years and the Biden administration getting involved in many of those cases, like, to what point do you think it will need to come in this case before the Biden administration steps in?
It's a great question. And to some extent, Joe Biden has already stepped in before the strike even started, because his whole presidency, he has called himself the most pro-union president in American history. So if that is true, Biden is on the side of the UAW. He is on the side of the striking worker. I don't know how you can be the most pro-union president ever and not be that way. So if Biden somehow says, I'm not really completely backing the union here, then he's lying about being the most pro-union president ever. So he might end up a little bit stuck on this if this gets to a second month or even a third month, because I think the strike will get less popular the longer these workers hold out. That has been the case for a long time. And let's remember, we do have a fairly large non-unionized automotive workforce in the United States. Tesla is not unionized. It's the most profitable automaker in the country. Almost all the transplants, the import brands that now all of them have plants in the United States, those are almost all non-unionized. And you got a lot of workers there saying, we get by. So what is so special about the UAW and these people who work for these three manufacturers that they should get more than the industry average? So I think those types of dynamics are going to become more intense the longer this strike goes on.
And Ricky mentioned popular opinion. I saw a CNN poll that showed that over 70% of Americans are on the side of the UAW and the workers. So I think that gives the union more ammo as they sort of like ramp up the rhetoric and keep it going. But as that dips down, that gives them more pressure, right, to sort of make a deal. I think that's the kind of formula that I see it.
Yeah, my guess price is that's a high watermark. Everybody is in favor of the worker when it doesn't cost the economy or cost ordinary people anything. And the longer this goes on, the automakers will be out there saying, look, we're making a reasonable offer. So the question is, to what extent will people believe them? And I think the longer this goes on, the more people are going to say, come on, UAW, you need to come to the table.
Yeah, I mean, we talked about the ripple effect. You talked about the ripple effect on car prices, Rick. Pras, there's also the ripple effect on the broader auto industry. I mean, we've been watching auto supplier stocks and manufacturers, for example, this morning, the likes of and auto parts makers, right? They're kind of mixed this morning, but definitely there'll be something to watch. Will people, for example, repair their cars more if they're not able to get a new car? We've been watching the auto dealers also. Yeah. Are they going to be able to get inventory going forward? So again, they're not moving much this morning, but they should definitely be on people's watch lists here as we go forward.
This is a big deal because of the Borg Warners of the world, the Lears of the world. when you shut down a plant, they don't need the parts anymore from those suppliers. So they have their lead times are only 2 weeks, like very short lead times. They have to shut down immediately. Their workers then have to go on, potentially on whatever state you're in. If it's because of the fact that another work stoppage is happening, you may not qualify for unemployment benefits, right?
Wow.
So depending on the state that you're in. So for the suppliers, it's a big deal. They have thinner margins. They don't have as much runway in terms of capital. It might be the pressure from the suppliers that say, hey, UAW, we need to like get going here because the workers that work on that side of the business are struggling.
That is a really interesting point and an important one for those workers and for people who are watching those stocks. Also, Pras and Rick, thank you so much. Team coverage on that big story this morning.
Bye,
well,
guys.
on Thursday, ARM finally saw its much anticipated IPO on the Nasdaq exchange, marking its second time in the company's corporate history. Then it went public at $56 per share and a valuation around $95 billion. The UK-based chip designer is the biggest IPO in the technology sector for the past 2 years. But the picture might not be so clear-cut. The company's valuation is a significant reduction from the anticipated $64 billion valuation from earlier this year. And according to our next guest, one of the big questions left is ARM's business model and the change in its business model, which might impede the company's success. Let's bring in Radio Free Mobile founder Richard Windsor to discuss more. Richard, talk to us about the business model change that the company has talked about, right, and what the implications are now that it's gone public.
Okay, so let's get a couple of things straight. The first thing is that the company hasn't talked about a business model change. What has happened is that in the lawsuit between ARM and Qualcomm is alleging that ARM intends to change its business model such that it would be able to earn, instead of 0.2% royalty on the handset smartphone industry, it might then be able to earn, say, 1% on the smartphone industry and increase its revenues on that market very, very substantially. In ARM's legal filings, ARM has emphatically denied that is the case. And so, at the moment you have to take them at their word, but there is a lot of talk in the industry about a potential business model change, and ARM doesn't completely rule it out in its IPO filing. So it remains a possibility. And the reason why I highlighted it is because the issue with ARM is not the company. The issue with ARM, in my opinion, is the valuation of the stock. There's nothing really wrong with the company. It's just the stock is too expensive. So we highlighted the business model change possibility as a way to justify where the shares are currently trading.
So, Richard, I want to ask you then, if the valuation is too rich, what does that mean long-term for ARM? Is this level like where it's sustainable?
Well, that's a very good question. At the moment, it's impossible to tell because, of course, the underwriters will be backstopping the share price's performance. It's not until that underwriting period is over that you would then start to see where the market really thinks the valuation of this company is. But let's say it stays around about the 60 billion where it is today. What I would expect to happen is if ARM resumes very rapid growth, as it is promising, and kickstarts margins and sees rapid EPS expansion, then I think you could see that kind of valuation be supported and maybe even trickle up over a number of years. The problem is that what if that doesn't happen? Then the investors who bought in at the IPO are taking a significant risk.
So it sounds like you're not touching this one at this point, Richard.
No, if I look at it from a valuation perspective, when I think about my own portfolio, I am a value-based investor. That's one style of investing. And I look across the semiconductor industry and I see much better valued good companies like Qualcomm, like MediaTek, like TSMC. And even, believe it or not, NVIDIA. NVIDIA trades at a significant discount to ARM. And so from that's why I think the shares are too expensive, yes.
So does that mean, like, is NVIDIA where it stands now, that's still a discount play in your mind?
No, I was just
it's all
highlighting
relative,
that.
I guess.
Of course. I was highlighting that from the point of view of, ARM is probably now the single most expensive semiconductor stock in the entire sector. I've also many times made the argument that while I think NVIDIA is an incredible company and has done incredible things, that the valuation of NVIDIA also remains too high. The part of the problem is, and I think ARM may suffer from this as well. It will take a little bit of time to see how the story that they sold the investors pans out. If ARM is now being valued as an artificial intelligence company like NVIDIA is, and it turns out that generative AI, as I suspect, is not the beginning of the dawn of super intelligent computers, when that bubble pops, you're going to see a substantial valuation correction. And I think that is also a risk from ARM if SoftBank has used the artificial intelligence story to sell the investors on a much higher valuation.
Richard, I want to ask you just a really quick follow-up question, just speaking of kind of just the opening up of different things happening. And one of the questions that we've talked about before is just, what does ARM signal its debut? I mean, it wasn't like to the moon, right? But it was a solid debut. What does this signal to you about kind of just the IPO pipeline? Like, do we think there will be more, even particularly in the chip space and the generative AI space coming following an ARM?
Yeah, I think what it indicates is that for specific sectors and subsectors of technology, the window is wide open, and you've seen that in some of the private financings that you've seen for generative AI companies. I mean, for example, there was a company in France that received money a month after it was founded, no revenues, no product, no strategy, and still somehow it got a valuation of $350 million. While that environment persists, and I would say that the IPO window for a company that can lay claim to the generative AI space is wide open, and there's probably plenty of capital to chase it. If you're looking at something else, say, something more boring or more humdrum in the semiconductor space, such as perhaps analog semiconductors, then arguably they're going to have a much tougher time having such a successful IPO.
Richard, I just quickly want to go back to something you said before, which is that you don't think we're at the dawn of a new supercomputing age. Is that what you said? Yeah. Is that right? Why not?
No, I don't think we're at the dawn of the super intelligent artificial intelligence. That's what I meant. Why not? Very simply. The technology which these generative AI systems are built is not new. In fact, it was invented in 1986 by Professor Geoffrey Hinton. Now, these technologies have a problem, and that problem is that when you use these technologies to create algorithms, these algorithms don't have causal understanding of the job that they are doing. They don't really know what they're doing. An artificial intelligence driving a car does not know it's actually driving down the street. What it's doing is calculating statistical probabilities. Until you can somehow encode causal understanding into these systems, they're going to make the mistakes. This is why they hallucinate. This is why they make all kinds of crazy errors. This is why they try to break up marriages and do all sorts of other crazy things, unless they're really strictly controlled. And in my opinion, because of that limitation prevents the dawn of super intelligent computing, which is what is built into the valuations of all of these companies. Hence, that's why I think it's a bubble. Hence, that's why I think it will pop at some point.
What is going to cause sort of that realization that these devices, programs, what have you, are not able to do what we've sort of almost personified it into thinking that they will do?
Well, I mean, a good model for how I think it's going to play out is what happened in autonomous driving. So when autonomous driving was hot, capital was flying into, there were lots of companies. And then it turned out that getting cars to drive themselves was a little bit more difficult than everybody said it would be. And as a result of that, what happened is a lot of the startups that were relying on VC and private equity money ran out of money. And then they had to come back to the market. And then the investor said, well, what about all these milestones you promised us? And they said, well, we haven't got there yet. Therefore, you got down rounds, you got disappointment, disillusionment, so on and so forth. In generative AI, I think that the business models that are being put out there to fund these companies are really unstable. You know, the benchmark at the moment is $20 per user per month gets you a generative AI service. When I look at the amount of stuff that's going on in the open source community, the stuff that's available for free, the flood of new models that are becoming available, I think a more appropriate price is something like $20 per year. Now, on the back of that, that means that all of those business models that they've promised investors are not going to work. Or it will just take many, many more users in order for them to break even. And at that rate, I think that's where you start to see the disappointment come in. So what I'm looking for is price erosion on generative AI services as the first signal that the bubble is starting to pop.
Well, my takeaway is it sounds like we humans are still relevant, so I appreciate that.
I think so. I think so.
All right. Thanks so much for joining us this morning. Radio Free Mobile founder Richard Windsor. Have a great weekend.
Thank you.
All right, we are a little under a week away from the Fed's September meeting. And interest rate traders largely believe the Fed will hold rates steady this month. The central bank has been digesting a number of economic reports that point to some slowing growth, but inflation remains above target levels. And the U.S. is facing a number of issues that could leave a mark. EY chief economist Greg Dacko joined our program yesterday, naming the triple threat facing GDP growth: the resumption of student loan repayments starting in October, a looming government shutdown, and the UAW officially on strike. Here with more on the economy and risk to markets is Victoria Fernandez, Crossmark Global Investments Chief Market Strategist. All right, so thank you so much for joining us this morning, Victoria. So let's get your view on these risks, these headwinds. Do you see these as the headwinds that we should be really paying attention? These student loan repayments, the strikes, are those the risks that you are kind of bracing for?
They're definite headwinds, Diane. I think we have to watch these elements that are there. Obviously, when you look at the strikes that are going on, that is the whole question of labor cost for corporations. How much higher is labor cost going to go, and what does that mean to margins? And then that flows through to earnings. So definitely a headwind. Student loan repayments, again, the strongest story of this economy for the past 2.5, 3 years has been the strength of the consumer. And so if that's taking a hit from student loan payments, then obviously that's going to be something we need to watch. You also need to look at oil prices. We are at 10-month highs right now. That feeds through to a lot of other elements. A lot of people think, okay, yes, that's going to hit the consumer in their pocket for filling up their cars with gas, but we have to remember transportation cost and input cost into all sorts of elements, into our groceries, into commodities, into everything that we do. Those prices are going to go up as well. That feeds into inflation. And so if inflation continues to be sticky, then that's obviously going to be something that the Federal Reserve is going to have to continue to fight. So yes, these are all headwinds combined with other elements. I think housing is something we have to watch too. Housing prices continue to go higher because supply is so low. Everyone thinks rent is going to come down and that sticky component of core CPI will go away. But if housing prices are moving higher, we could see some resistance there as well.
So, Victoria, putting this all together, the S&P 500 is down about 1.8% since its most recent high. Does that reflect the concerns? Does that adequately reflect the concerns that you're talking about?
I don't think it does, Julie. And it's an interesting fact. If you look over the last week and a half or so, I really think the market has kind of changed the way that they're looking at some of these economic reports that we're getting. A couple weeks ago, 3 weeks ago, we were in that good news is bad news environment. Anything that came out that said the economy was strong, the market and investors looked at that as, that means the Fed is going to continue to hike rates. We've had a shift as of late, and it looks like the market now is looking at good news as actual good news for the economy. I think that means they believe the Fed, if they're not done hiking rates, they're pretty close, right? Maybe we get one more hike later this year in November, and then they think the Fed might be done. And so they're starting to shift the way they interpret this data. That might be one of the reasons that even in a week when inflation is higher than expected, the labor market is stronger than what people anticipate, and we're even seeing rate cuts get priced out of the market that had previously been priced in. You still have, all in all, a pretty decent equity market this week.
So, Victoria, I want to ask you, how do you position your portfolio when you consider, like you mentioned, about just the latest inflation prints? I know it was not the Fed's preferred gauge, but it's something that registers, especially ahead of the next decision on rates and the path of rates. How do you position your portfolio when there is the possible risk. I mean, I know largely speaking, the expectation is a pause this meeting, but there's a risk, right, that the Fed could raise rates again this cycle. How do you position your portfolio with that kind of just uncertainty?
Yeah, no, you're right. There's definitely not a zero probability or 0% chance that the Fed hikes rates, even though most people think they're going to pause. But we think that means there continues to be choppiness in this market. It's what we've been talking to our clients about over the last few quarters. And that doesn't mean that you go to cash. It doesn't mean you come out of the market, but you do have to be choosy where you are placing your money and your funds in the market. And that's what we're doing with our clients. We're trying to create a very balanced portfolio, balanced not only within the types of investments, equities, alternatives, fixed income, but also balanced within the sector. So within the equity market, you want to look at companies that have strong balance sheets, good cash flows, that maybe have pulled back a little bit as of late, and you can go in and start building a position or adding to a position at an opportune time. It's not necessarily sector based, but it's more idiosyncratic, more company based at this point. So you can look at names like a Gilead that's had a pullback. It's been lagging a little bit, but they have strong cash flows. They have a 4% dividend. Their valuation is reasonable in the low teens. So you can find individual companies that you think are doing well and add to those positions. I would also add real quickly, I think you have an element of fixed income, generate some cash in that short end of the curve and maybe add a little bit further out for duration purposes, and look for some alternatives as well. Covered calls, an equity market neutral strategy, something that can give a little bit of a tweak to your portfolio and allow income generation even when the markets are choppy.
Victoria, I want to just ask you, I'm getting a message from one of our colleagues, and I didn't notice this. Is there's Texas A&M mug there? I didn't see it, but one of our colleagues saw it, and they have the question, do you think Jimbo Fisher is a good investment at this point? Really quickly.
That's a dangerous question for me to ask, but so far so good. So let's go Aggies.
All right, we'll leave it there. Victoria Fernandez, thank you so much for the investment and sports investment advice. All right, all your markets action ahead. Stay tuned. You're watching Yahoo Finance. All right, we are counting down to the opening bell on Wall Street. Let's do a quick check of markets sponsored by Tasty Trade. We are just seconds in, actually. Opening bell ringing on Wall Street as we wrap up this full week of trading in September. Want to take a look at where markets are opening out the gate. They had been a little under pressure heading into the open, and you're starting out with a little bit of pressure as well. The Dow right now down a little over 0.1%, so meandering a little bit there, down by just about 50 points. S&P 500 under a little bit of pressure as well, down 15 points, so down 0.3%. Nasdaq also opening softer as well, also down 0.3%. Down 45 points. Let's get right over to Julie at the Yahoo Finance Interactive.
Yeah, and I'm going to start with another asset class, actually. Since you already looked at stocks, I'm taking a look at the 10-year yield here, hovering at around 4.31%. It hasn't moved much this week, but it has held steady at that relatively elevated level here. If you look at the month chart, you see also that kind of stability, but remaining at that high level ahead of the Fed's meeting next week, at which the Fed is expected to hold interest rates steady and then perhaps raise at the following meeting. But that's something that we continue to keep a close eye on. We also continue to closely watch what is going on with oil. Now, oil at the moment is down about 1% here, but still trading just shy of $90 a barrel. And we really have seen that big upward move in oil still on this month chart here. You've seen it go higher. Let's get back to today's session and what we're seeing on the move. And I'm going to start like Brad Smith likes to do with the sectors here. Communication services, the only group that's in the green today. Energy now turning lower after having been the big winner thus far this month and this quarter to date. Real estate lower, financials lower. But I want to take a look at the 5-day view as well to see what has happened over the course of the week here. Consumer discretionary, utilities, communication services, all strong on the week. So now seeing this little weakness to end the week. Tech has been the big loser on the week. And now let's get to the Nasdaq 100 and what we are seeing in today's session here for large cap technology. It's really a mixed bag here today in terms of what we're watching. Amazon faring the worst, down about 1.1%. Alphabet and Tesla slightly in the green. And again, to look at the weekly look, happy Friday, we've got Tesla actually up 11.8% on the week here. Some analyst chatter that has been affecting it here. And I'm not sure if we have some auto stocks that we can look at on the boards here, but obviously cars, there we go. We are watching them closely. Well, these are the auto parts makers that we are watching here, and the auto adjacent companies, which we have been watching closely as the strikes get underway.
All right, Julie Heinemann, thank you. All right, let's take a look at some of the trending tickers we are watching this morning. We've got Adobe in focus this morning, out with its earnings. It reported after the bell yesterday. It did beat on the top and bottom line, but the company released a conservative sales outlook. Shares are under pressure at the moment, down nearly 4.5%. You got several analyst notes out on it. I mean, look, JMP sticking with its market perform rating on Adobe. After the company announced it was, again, those better than expected results, guidance, it was relatively in line, but it could be, once again, one of those stories where, where Wall Street wanted to see more. Like they always want to see more with regard to guidance. Even Oppenheimer seems bullish on saying it was impressive results in its third quarter. So it's interesting to see kind of a little bit of this takedown, which we saw in the aftermarket yesterday after they reported earnings, kind of some of that pullback ahead. So not surprising in terms of the initial stock reaction.
Yeah, I mean, keep in mind the stock's up 64% year to date, even with the movement that we're seeing today. So to your point, that sort of enthusiasm that's baked in, Adobe is seen partially as an AI play. So that's part of the enthusiasm. And it has been getting a lift from its new Firefly product, which allows users to generate images and language and graphics, right, using AI. So that has helped the company. But it does, again, seem to be a victim of these elevated expectations. Right. Even that fourth quarter forecast, if you look at it, earnings per share of $4.10 to $4.15, analysts were estimating $4.06, which is lower than that. Revenue kind of in line with estimates. But I guess for these sort of AI forward companies, in line is not good enough,
No.
I guess, in the eyes of investors. So that's kind of what the vibe is like here. But we're going to talk about the vibe a little bit later in the show and the business, the nitty gritty of the business. I'm going to be speaking with David Wadhwani, Adobe president of its digital media business, which is the biggest chunk of its business. And that digital media revenue, by the way, was up 11% last quarter to $3.59 billion. So looking forward to that conversation. Well, another mover we're watching is DoorDash. MoffettNathanson downgrading the stock to market perform from outperform, and the firm citing the resumption of student loan payments as a bookings risk to the food delivery businesses, not just DoorDash, but the others as well, though I think they're still positive on the likes of Uber. Yeah. So those shares down about 3% today. But this is interesting. We keep talking about the student loan resumptions.
And what that's going to do.
And we're going to be talking about it later in the show as part of our series on the topic. But then we keep getting these sort of waves of commentary about how it's going to affect
the businesses.
Yeah.
But interesting to note, like you just noted about Adobe and how far they've run up this year. Similar story for DoorDash. They're up more than 60% year to date. So it's not that much of a knock-on effect in terms of the share price for it. So it looks like it's just a little bit of cooling based on, this perspective from MoffettNathanson, this headwind that we're seeing that, a lot of companies are kind of bracing for what is going to be the fallout from the student loan repayments. Where will people be cutting back? They could potentially be cutting back. It's not a necessity,
Right. Well, and as he talks about, if you think about the cohort of Americans that uses these services the most, as he says, it's in the 25 to 44 age range. That also happens to be the age range that is the most saddled or the most affected with the student debt that is going to have to be starting the repayment. So it makes sense. We'll see if it actually has that sort of effect.
One other tidbit.
Yes,
we know,
please.
DoorDash is moving to the Nasdaq.
Oh, it's domiciling or whatever you want to call it. All right, well, we'll keep an eye on that as well. And then also we are continuing to watch shares of ARM. They are still pushing higher after the company's blockbuster IPO. The SoftBank-backed business was valued at around $60 billion at the open of Nasdaq trading yesterday. We were just talking with Richard Windsor at the top of the show about valuation questions, and those were similar questions that were raised in the Heard on the Street column in the Wall Street Journal today, basically saying, like, if you look at the growth that the company has projected, and if you look at its valuation today, something doesn't entirely match up.
Yeah, but one thing that it could be good for, and just a good signal, it's, the best debut this year within the IPO space. So could it signal kind of just that release of more IPO activity that we've been waiting for? Does this bode well for an entirely different industry like an Instacart?
Right. Well, reportedly, Instacart has now raised the range or raised the pricing, targeted pricing for its IPO. So obviously, the bankers over there were very closely watching what was happening with ARM and maybe taking some cues from that. So we'll see what ends up happening here. One more interesting note, just echoing all of this valuation talk. Needham actually already initiated coverage of ARM with a neutral and said the valuation looks full.
Oh, wow. All right.
So obviously there's a lot of people saying things to that effect.
Exactly. We're full. All right. All your markets action ahead. Stay tuned. You are watching Yahoo Finance.
We keep talking about the student loan repayments coming back. I mean, this is something we've been looking ahead to. It's finally going to be happening as of October. How much of an effect is it really going to have?
I think it's one of those things that's just another data point when it comes to the health of the consumer, and another reason why we could see volatility going into the end of this year. If inflation proves to be stickier, if we start to see more of a deterioration in the employment backdrop, then you're going to see consumers making the decisions that they've been making all year in terms of the nice to have versus need to have, and they're going to focus more on the need to have.
Good morning. This is Yahoo Finance.
Big news, 3 things that you need to know.
We just got the announcement.
What happens now?
Now I got a question.
What does success look like?
What was one of the biggest challenges that you faced?
How much does that raise the odds for a recession?
This phase is over. Tell me what happens to the debt ceiling.
Where does generative AI, though, fit into your portfolio?
Talk to us about this diversification and what investors need to know.
And I think it's important. This is the stuff that gets me out of bed, fired up.
What's the gateway? What's the new bridge to opportunity?
Doesn't matter if it's a soft landing or a hard landing.
Big interview. I can't wait.
Supreme Court out with the ruling on President Biden's student debt cancellation.
Right, let's turn now to some recent tech earnings. And they give you information if you watch them closely.
President Bostic, President Investor Gary Gensler, thank you so much.
Part of what Davos is about is sharing best practices, coming forward with ideas, and then enabling those ideas into action.
And I would add that there's more to come on this.
And we keep producing products that help people lead healthier lives.
This is one of those rooms they use to simulate light in space.
Interest rates will come down again.
Figure out where your money is going now. You gotta scope that out.
And the numbers really tell the story.
What does all this mean for you?
Keep it tuned into Yahoo Finance.
Welcome back to Yahoo Finance Live. Let's take a quick look at markets here. We are seeing indeed a downdraft to end the week, with the Nasdaq leading declines. It's off by 0.75%. Let's get to Jared Blickery at the New York Stock Exchange with the latest on what's going on. And you, just like we've been watching the oil prices this week, Jared.
Yes, a downdraft in stocks and up week in oil. Let's take a look at the Wi-Fi Interactive, where I am showing our commodities heat map. And by the way, slight digression here. Just look at the top row here. We have wheat in the upper left, followed by palladium. Each of those up more than 5%. Sugar, natural gas, coffee, cocoa, platinum, and then crude oil up 3.1%. So we're seeing a broad swath, especially the softs commodities, bumping this week. Here's WTI. And we can see over the last 5 days this week, it is up 3%. We are off a little bit off of those highs yesterday. We had a slightly bearish report come out from the U.S. Energy Agency yesterday. And guess what? The market just blew past that. The bulls are definitely in control of this market. We are currently below $90 per barrel, but we were surging above it for the first time in almost a year only yesterday. And here's a look at the 2-year chart of crude oil. You can see $85 was really the line in the sand. Some people say $90. Regardless of wherever you think that resistance was, the price has now is in the process of pretty substantially clearing it. Still need to see a couple closes above 90 here. Just thinking about how this fits into our play of stocks, let's go to the price action for the week, and we can see energy up about 1% on the bottom row there, but still posting some gains. Tech, the most bearish as we're looking here. And then just thinking about the US dollar. All of this bullishness in the commodities is all the more impressive when you consider that the US dollar index is also up this week. Typically that might act as a headwind since it is the denominator when you're taking a look at some of these prices like dollars per barrel or barrels per dollar. So US dollar index up 5 days here. Let's take a longer term look, very longer term look. Here's the 10-year. You can see the recent price action, just a blip, but if we were to surge higher, 120, 115, 120, those are definitely in the cards. So we'd want to watch out for that. And then while I'm also talking about currencies, I want to talk about China. We had some stronger than expected data overnight coming in. We also had some actions by the Chinese central bank. So industrial production and retail sales, those beat expectations. And I do have some information about what the central bank was doing. They kept their rates the same, their main refinancing rates the same, but they added $26 billion into the financial system via one-year loans. So that's a form of stimulus. They cut lenders' reserve requirements, also injected 34 billion yuan into the 14-day money market loan. All of this to say that they're really trying to juice the economy, but so far traders have looked past that. The Chinese yuan was a little bit stronger on the day, but not much that you could see. And so all of this points to the fact that China, despite notwithstanding this morning's figures, probably faces a number of headwinds. And just bringing it back to our discussion of crude oil, that could be the marginal player that really decides just how quickly, and I think it's a matter of when, not if, we get to $120 a barrel in WTI.
Oh, that's a good question. When, not if. All right, thank you, Professor Jared. All right, switching gears. UAW President Shawn Fain leading the charge as the union launches a historic strike across all big three automakers, GM, Ford, and Stellantis. Fain making an appearance at the picket lines, vouching for UAW members. Let's take a listen.
Record profits equal record contracts. It's our time, and all we want is our share of equity. We're not asking to be millionaires. We're not asking to join the billionaire class. We're asking for our fair share of the fruits of our labor.
The walkouts in the union's new stand-up strike strategy are hitting factories in Missouri, Ohio, and Michigan, while the UAW warns of more sites to be called on to strike if talks with the automaker stall. Here to discuss all this and more is Michigan State Professor Peter Berg, along with Kate Brofenbrenner, Cornell University Director of Labor Education Research. So thank you so much for joining us, to both of you this morning. So Kate, let's start with you. You talked about this looming strike. It's happened. What is there's obviously an initial impact, but let's say this goes on for a long time. What are we expecting in terms of the economic impact of this?
Well, this is a strike in one of our biggest industries in the country, and it's all across the country. It affects not only the auto industry, but the parts industry. And also, it's being done in a very creative, strategic way, which is they're not striking all at once, but it's going to be, they're, going from one target to the other, which makes it hard for the auto industry to plan, where they don't know where they're going to be struck next. They don't know how long it's going to go at each of the targeted plants. That makes it much more difficult to plan for replacement workers, and it makes it it gives the union an opportunity to build their power and build the commitment of the workers for the strike.
Peter, as we look at this strike, partially what has to make it work for the union is to have broader support, one would think, right? Among Americans, among their communities, et cetera, that are also being affected by it. We talked about this a bunch at the top of the show, that right now, most Americans are on the side of the UAW. But how long is that going to last, and what effect is that going to have as the negotiations go on?
Well, I think the communities that are where the striking plants are will be the most affected to begin with. And so they'll work to increase solidarity among those workers. But Shawn Fain has been very good about moving public opinion and emphasizing various aspects of public opinion. As longer the strike goes on, the more effect it will have on workers. But it's the job of the union to really keep the solidarity together of its members and the public at large.
And Peter, I want to ask just a follow-up question. I mean, we just heard Shawn Fain talk about they don't want to be millionaires, they don't want to be billionaires, they just want fairness. Is there, what seems to be the priority for the union, and especially when you think about pay? And there's truth to the, divergence in CEO pay between worker pay, right? When we're talking about a variety of industries, there's been a big increase over the years, going back from the 70s to now. What stands out as the priority from the unions?
I think right now pay is a priority, and they have effective arguments there in that there's been a decline in real wages since the mid-2000s in the auto industry. And at the same time, you've seen profits really increase for the auto companies. So this argument, it works for the union, and they're able to show we're suffering at the expense of really increasing not only in CEO pay, but in the profits for the organizations as a whole. Plus, there's public money available for this transition to electric vehicles. So the union's going to emphasize we're not asking for anything that's really dramatic. We're asking, as you heard in that clip, Shawn Fain saying our fair share. And I think that's an argument that will resonate with the public at large as well. Where they deal with things like pensions, bringing back pensions, or cost of living adjustments, or shortening the work week, I think that's a different issue. That adds to sort of these non-wage costs, which can escalate a lot for companies. But I think on the wage issue, there's still going to be some more ground to go there.
I keep coming back to the figure that I saw about how much it costs the big three to make cars in terms of the labor cost per car versus a Tesla with an ununionized workforce. For Tesla, $45 to $50 per hour per car. The big three, it's more in the 60s. So, Kate, do the automakers have a place to say here? It is expensive. This is causing, even though I guess the executives are making the money that they're making, but in terms of the profit margins and the cost per car, that they are getting squeezed to some extent.
We have to remember this is going back to the recession in the 2000s. That the workers made concessions. They made concessions on both wages and benefits. They ended up with a two-tier, which is very destructive for workers because it has workers working alongside each other, making different pay, more temporary workers. Meanwhile, the companies are making profits. Not just this year, but in the preceding years, and they've decided to put the profits into, to the CEOs and not the workers. So workers are angry, and yes, the company is, concerned about their future profits, but the workers feel like they sacrificed both in the recession and then during COVID, and they feel like the company was asking them to sacrifice, and they're not making the sacrifice.
And then I want to ask to Peter or Kate, either one of you, just to talk about, so we know that President Biden is a big union guy, right? What does this do to his kind of relationship with unions? What's happened now? He's got to, come out and say something, right? Does this bode well what has actually happened? Like, they are striking now.
He's in a very difficult position. If he went out and gotten involved and the strike dragged on, he would have been blamed for it. But if he doesn't get involved and the strike goes on, he's also could be blamed for it. So he has to balance that. And what he's done is sent in, his staff and having the acting Secretary of Labor go in. But he's behind the scenes. They're trying to help get a settlement, but he wants to be careful about putting his weight into the strike because it could go either way and it's not going to be good for him.
And Peter, one of the ongoing questions I've had as we've had these various labor actions, not just with the automakers this year, right, but of course with UPS as well, with places like Chipotle and Starbucks. Are we seeing any kind of turning point, inflection point in union membership in the United States, which has been declining even as we've been getting these sort of very visible union actions?
I think with union density, it's very hard sort of for unions to increase their membership relative to the wider labor market. They can increase members, but growing in density is very difficult under the US system, which requires them to win representation at every location that they schedule a vote. So while there is more labor activism, I think while the public supports, surveys indicate there's more greater public support for unions, the US system makes it difficult to win representation at each individual location and therefore grow union membership. So they face some headwinds at the same time that they're seeing more support among the public.
All right, we will have to put a pin in our conversation. We'll certainly continue to follow what's happening with the UAW and these latest strikes. Peter Berg and Kate Bronfenbrenner, thank you so much for joining us today.
Thank you.
All right, we've got more of your markets action ahead. Stay tuned. You are watching Yahoo Finance.
Adobe beating on the top and bottom line in the company's third quarter, though investors slightly disappointed as the company's AI demand perhaps did not have a greater impact on forecasts. In the next hour, we'll speak with David Wadhwani, Adobe's president of the digital media business, for more on the trajectory of the company.
And we'll hear from ARM CEO Renee Haas after Thursday's blockbuster IPO. Don't miss that.
Make sense out of what's happening in China for us, and are we getting any more clarity that we need on the markets front?
So China is stimulating its economy. A lot of people think they're not, but they clearly are doing it. But it takes time, and I think that China is not in the policy that we did, like a big reopening and trying to stimulate it through free checks and say, let's go and spend a lot of money. Chinese consumers are different. They're also very cautious because what happened during extensive lockdowns, they're wary. But there is some change, and I think that this is about China being very gradual in its approach, knowing it can reach its goal for 5.5% growth. It may not happen this year, however, it may be something for next year.
It is just after 10 a.m. in New York City. This is Yahoo Finance Live. I'm Diane King Hall alongside Julie Hyman. We're about 30 minutes into the trading day. Let's take a look at how stocks are moving. Stocks are under some pressure this morning. You're looking at the S&P 500 down about 0.4%, but Wall Street is heading towards a winning week. The move higher in oil prices continues to be a focus. Crude trading at 10-month highs and boosted this morning by stronger data out of the world's second largest economy.
And looking at individual names, we were watching Shake Shack on the move today, up 2.25%. The stock is getting a bump on an analyst call from North Coast Research, which is raising it to buy from neutral and citing improved traffic trends. The analysts there expect strong commuter traffic in the summer will continue this fall as employees get back to the office.
Shares of Apple trading under a little bit of pressure, down 0.4%. Pre-orders for the iPhone 15 opening earlier this morning. And delivery dates for the Pro Max already getting pushed back to October. Bloomberg is reporting China seeing shipment delays of 4 to 5 weeks for the Pro Max.
And shares of steelmaker Nucor trading lower by about 2.6% after issuing weak guidance for the third quarter. The company sees diluted earnings per share in the range of $4.10 to $4.20. That is well below estimates. And in the second quarter, the company reported $5.81 a share. The decline attributed to slowdown in multiple areas of that business. Well, we just had University of Michigan Consumer Confidence, the preliminary reading here for September, so very current data, and it came in a little bit lower than economists were projecting, and a slowdown from August at 67.7. That's versus 69.5 in August, and versus the 69 that analysts had been projecting. Some interesting things within the data. This is broken out into current conditions, which deteriorated quite a bit to 69.8, expectations, which improved to 66.3, and to me, the most interesting part of this, inflation expectations are moderating. Even though we have discussed some concerns in the market here that the rising energy prices will start to put pressure not only on headline but trickle down into core inflation, one-year inflation expectations falling to 3.1% from 3.5%, Diane.
Yeah, so it is interesting to note that, and also just the divergence in expectations in current conditions. That's always something that that often stands out to me. And another thing that was interesting to me, that consumers don't really care at this point about potential government shutdown. That they, pointing out in the survey that they didn't mention it.
Few people worried about it, but so they said that could change.
Yes, it could change, and that often changes as we get closer to that. The potential of that happening, and it's all, like we always get right there, and then
right up to the 11th hour.
Exactly.
So we'll continue to watch those sentiment numbers also as we get the revisions to this preliminary reading. All right, well, shares of Adobe trading lower by almost 4%, despite the company's numbers beating on the top and bottom line in the third quarter. The fourth quarter sales outlook was in line with expectations. Some investors seem slightly disappointed the company's AI demand did not have a greater impact on forecasts, although sales forecast was above what analysts have been anticipating, depending on how you look at it. Here with more on the results and how the company's AI push will affect the bottom line is David Wadhwani, Adobe's president of its digital media business. David, it is great to see you. You guys have been up to a lot of interesting and exciting stuff with the launch and expansion of Firefly, which is your AI-backed product here. And I know you're talking about a lot of big numbers surrounding that. So give us the sort of big level view here on Firefly and on the expectations for that.
Yeah, thanks for having me, Julie. It was, I'd say, in terms of orders of innovation, this has to be one of the biggest orders that we've ever delivered in terms of new product capabilities. We've delivered something called Adobe Firefly. Firefly is our family of basically foundation models for creative generation. So think of it as things like text to image, text to vector, ultimately including text to video, text to 3D, anything you can imagine dreaming up for what you want to do with media. Firefly is going to be the set of models that get you that. So we introduced that. We also integrated it deeply with our new product offerings like Adobe Express, but also with our flagship applications like Photoshop and Illustrator. And the response has been phenomenal. First of all, social was enormous for us. The capabilities went viral. We saw over 2 billion images generated in the first 6 months of the beta alone. And we also had 3 million downloads, over 3 million downloads of our flagship application betas, which we've never seen before. So community response has been amazing. And so that really set the foundation for everything we've been delivering. And it's worth noting that not only have we delivered these a few months ago in our beta, but a couple of days ago, we announced that all of this is now generally available. And it's just been great to see the response from our community.
And talk to us about how that is then going to translate into sales, right? You all, I believe, forecast sales in the fourth quarter of as much as $5 billion, helped in part by demand for this product, which is sort of still ramping up. As you said, it just became widely available. Right. Maybe the street was looking for a little bit more oomph from it at this point. I mean, as you know, expectations out there for anything attached to AI are so high at the moment.
Yeah, it's a very important thing for us to sort of establish is that, we introduced 5 new offerings yesterday, if you really take a step back in the last couple of days. First was Adobe Express with Firefly, and this is our all-in-one app for really anyone to be able to use the best of Adobe to create social content and output. We introduced Firefly as a web app as well. So if someone wants to have a playground for experimenting what's happening in AI, they can go use Firefly. Of course, our Creative Cloud applications are now generally available with Firefly as well. And we introduced something for generative called Gen Studio for enterprises that want to really supercharge their content supply chain. All of that is now in market. We also introduced a new pricing model for generative called Generative Credits for subscription users. And so this is all brand new. We launched it literally 2 days ago. And, Adobe's always been very disciplined in terms of how we think about the opportunities. We believe these are going to ramp over time. Our primary focus right now is proliferation of these products. We believe they are best in breed and they're here. We're not just talking about them. They're actually, people can go and use them today. And so we want to price it so that we get as many users in this as possible. We really believe in our mission of creativity for all. And that's going to really proliferate the top of funnel. And then what we have to do is the hard work over the next few years of driving the business and converting them and journeying them to more and more paid plans. And we really feel very strongly this is going to play out very favorably for Adobe. It's just going to play out over the course of the next couple of years.
One of the interesting questions I thought that was asked on your conference call was about margins at Adobe, that it's quite expensive to sort of gather and then process all of this AI feed data, right? Whether you're talking about images or all of the other things that are being fed into it. Can you give us a little more color, as the analyst asked, on how you are able to maintain and grow the margins given those increasing costs, even with the prices going up for some of these products?
Yeah, at Adobe, we've always prided ourselves in the basic concept of growth and profitability. Like that's always been the core. At the beginning of this year, we had guided the street to the mid 44.5% margin. We've been beating that handily. Last quarter actually went over 46% margin, and that's because and this is despite all the innovation that we've been doing, and everyone can trust that we are investing very aggressively in developing these models and the inference it takes to actually run these models. And you saw how much usage these have gotten. So our focus continues to be to invest more. We think that there's going to be a lot of opportunity to build out models beyond imaging and vector, now going into video and 3D and more. And so the goal is going to be continue to invest there and try and really sort of maintain margins as we've always done in the mid-40s. And we believe we have this potential because we also see upside to everything we're investing in here. And we've always been very disciplined with how we think and plan, our years ahead. So we feel very good about the ability to maintain mid-40s margin while investing very heavily in AI.
David, forgive me, I don't know the answer to this, so that's what I'm going to ask you. I think of Adobe as a company that serves creatives in large part. And right now, there is a big strike that is affecting creatives in a big industry, the Hollywood industry. And I just wonder if there's any feed through for you guys in terms of projects that are on hold right now, where perhaps at some stage of the making process, the Adobe tools would be used.
Yeah, I think the discussion and the discourse that's happening right now is a really important conversation for us to be having. One of the things that we've really tried to do is build everything we do in a creator-friendly way. Our customers are creative professionals, and we really and really everyone trying to express themselves creatively, even small business owners and individual solopreneurs and TikTok stars. So the goal for us is to create AI and leverage and build AI in a way that's really positive for creators. We believe that it's about doing it in a creator-friendly way where these tools take the creativity, take what's in their mind, and give them the ability to superpower what they do by maybe taking away some of the mundane work, but really leaving the creativity and the expression in the hands of creators. So that's why we launched Firefly the way we did. We did it with content that we know we have complete license rights to. 2 days ago, we actually paid all contributors for content that came into participating in the training of our models. We've been working with regulatory bodies in Europe and in the US to think about different ways that we can actually engage on regulation so that creators have the ability to really defend their styles and their content. And we've also introduced something called content credentials, so that if someone creates content that they don't want trained on, they can absolutely put in a do not train tag. And the whole idea here is AI has so much potential for good. We just need to introduce it in a way that is supportive of creators, and we believe very strongly that we're trying to get that balance, both in terms of what we do and how we work with regulators.
Yeah, obviously an enormous amount of attention on this. We had the meetings, of course, in Washington this week as well to focus on all of these thorny issues. On a related note, are you seeing any kind of slowdown in demand from the TV and movie business as a result of what's going on?
We as we mentioned in our last quarter, we're seeing broad-based demand for everything. So our metrics, when it comes to the creative business, continue to be very strong. And while I understand that there's some, that this is an issue that the broadcast and the video industry needs to work through, we have not seen any of that reflected in our numbers.
All right, good to know. David Wadhwani, thank you so much for your time this morning. Really appreciate it. Adobe president of the digital media business. Take care.
Thank you, Julie.
Thanks. We got much more coming up. You're watching Yahoo Finance.
You have tons of great economic analysis, markets analysis as well, but you're also training for the New York Marathon. What is your number one tip for all the runners out there that are perhaps trying to get their miles in and see you when they're running throughout the 5 boroughs here in New York later?
Yeah, well, first of all, you have to be really determined to do it. Do not give up, because as much as it can be very painful and exhausting, when you get through that, you feel great. So just keep going. And keep training with consistency. You can't slack off, so to speak. You gotta do it every other day, I would say, or every 2 days, and really put in the work. You'll make it.
Let's do a check of the markets. What are they? Monkey markets? Sponsored by Tasty Trade. Can you tell it's Friday? We've got the Nasdaq that's down almost 1% in today's session as we see underperformance in large cap tech today. The S&P off by about 0.6% and the Nasdaq down about a third.
Well, it has been almost 24 hours since ARM Holdings finally made its public debut on the Nasdaq. Shares rallied nearly 25% on its first day of trading at $56 per share. Shares gained some more ground this morning, up right now just 1%. Yahoo Finance's very own Josh Lipton spoke to the CEO about the IPO, its chip designs, and the transition to machine learning AI.
We're here with Renee Haas. He's the CEO of ARM, the British chip designer making its big public debut today. Renee, thank you for joining us.
Thank you.
So, Renee, first and foremost, what does this day mean for you, for ARM? And I'm also interested in just walking us through how ARM is different today, Renee, than it was when you were last public.
So it's a very exciting day for me personally, obviously, but I'm really more thrilled for all the ARM employees across the world. We had an amazing celebration this morning in Cambridge when the button was pushed. And I think, in general, returning to the public markets is a very exciting thing for us. We're a very different company than we were in 2016. Back in 2016, about 65% of our revenue came from the smartphone mobile world. Today, that's about 45%. And we're a much more diversified business. We're into the cloud data center, we're into networking, we're into IoT, we're into automotive. It is a very, very different business than we were back in 2016.
Front and center, Renee, for investors is growth. You know, revenue in your fiscal year ending in March, relatively flat. I think investors are interested. How do you re-accelerate that?
So the last 3 years prior to now, we actually had a 15% year-on-year growth in terms of CAGR. We're a company that's a little bit hard to measure on a year-to-year basis. You almost have to look at the broad trends over time. The diversification of our business was really what came to fruition in the last 3 years, which is why the growth. Going forward, we're even more excited about growth when we think about AI. It's impossible to build AI without ARM. AI for us generally means where you didn't have a CPU, you may need one. Where you have a CPU, you may need more. And that is across all markets. It's in autonomous vehicles. It's in edge devices like your Google Assistant, your Amazon Alexa. It's also in the cloud. And NVIDIA has announced their most advanced product called Grace Hopper, which takes what was an x86 CPU and replaces it with 72 ARM CPUs connecting to a NVIDIA GPU. You can't run AI without a CPU. You can't run a GPU without a CPU. So the AI growth curve for us, we're super excited about what that means.
And when you talk about NVIDIA's super chips, so the GH200, as you know, that's including ARM CPUs. Do you plan, Renee, on kind of broadening and deepening that relationship with NVIDIA and other AI players?
You know, going forward, I can't talk too much about unannounced products, but you get a sense of, at the NVIDIA announcement, just what the capability of ARM could be in the future. Why ARM and a chip like that? AI requires a huge amount of compute cycles. It also needs to fit inside the power envelope of an existing data center. ARM is all about power efficiency. So as more and more of these AI compute workloads move to the cloud and other devices, I think you can imagine similar partnerships going forward.
And I have to ask you today, just yesterday we had these tech moguls meeting with lawmakers on Capitol Hill. It's interesting about the AI industry because you have leaders in that industry who are calling for regulation of their industry. Are you on board with that? Do you think we need to see regulation, and should it be this sort of the federal AI agency some folks are talking about?
Yeah, I don't know exactly what the answer is relative to an international body, a domestic body, but maybe a little bit analogous to when the vehicle was invented. You had horses. Horses didn't have traffic lights. They didn't have lanes. You now had a new device that people had to figure out how to navigate a new system through it. AI is not exactly a vehicle, obviously, but there's also some analogies in terms of we have a new, incredibly powerful technology that can cause a lot of good for humanity, but we just need to figure out what those rules and regulations need to be. So I think the energy being spent on it is right.
And we talked on AI, the opportunities there, Renee, but let's talk smartphones for a second. So obviously your company designed the architecture of chips used in about 99% of smartphones, right? Is that still a growth story for ARM?
You know, I think it is from the standpoint of these devices are more and more complicated to build. While the smartphone market has saturated in the last number of years, the complexity of technology inside has not. And they get more and more powerful, they require more and more technology. And your mention on market share means the opportunity for ARM to bring more value is there. So I imagine our growth will come from bringing more value into the smartphone sector.
And I do have to ask you, Renee, about China, about 25% of your revenue. How do you think about the opportunities and the risks in that market?
So the growth in China for us in the last few years have been very similar to other areas. We've grown a lot in the data center. We've grown a lot in vehicles, automotive. There's a huge push towards EV in China. China wants power efficiency. China wants open software ecosystem. Those are all strengths for ARM. You know, I would say in terms of the risks with China, my worries are no different than any other tech CEO in terms of navigating through the complexities of that. But broadly speaking, you know, China's been a very good market for us.
All right, Renee, thank you so much for your time and congratulations again.
My pleasure. Thank you so much.
All right, that was our Josh Lipton and Renee Haas, CEO of ARM Holdings. Meanwhile, we've got more of your market action ahead. Stay tuned. You are watching Yahoo Finance. Amid volatility and concerns surrounding the banking industry this year, investors and businesses are turning to private lending firms like Blue Owl Capital for alternative investment management. Joining us now to discuss the emerging trend and their latest quarterly earnings, Blue Owl Capital co-CEO Mark Lipschultz. Mark, you guys have seen impressive growth. Your assets under management, what, $149 billion? They've about tripled since your IPO in 2020. What is going on? For people who are not familiar with this private credit market, like, give us sort of the overview. What has gone on here that has caused this explosion?
Well, first, thank you so much, Julie and Dan, for having me. I really appreciate the chance to chat about it. You know, what's causing the growth is private lending, direct lending. The Blue Owl solutions deliver value. Like any product in the market, financial products are just that, right? They're innovative products that compete in a broad marketplace. And direct lending is really, if you take a step back, it's essentially offering what the banks we all picture of old providing, which is making a loan, being a partner to the business, and being a long-term partner to that business and able to work through changes in the world together. So we're really a non-bank bank. We don't have any depositors, so there's no risk to the system. There's no systematic risk. There's nobody on the hook besides us and our investors. And we're just trying to make a great risk reward for our investors. And the reality is the growth reflects the fact that we have a value proposition that works for the people that provide capital, an outstanding risk reward for the people that provide us the capital, and we have a great value proposition for the people that use the capital. We're a long-term partner that gives them the privacy, predictability, and partnership they want in a lender.
Speaking of the people who need the capital, one of the things that we saw with regard to the regional banks is they support a lot of small businesses. Did you find an influx from small businesses seeking an alternative kind of investment platform?
So our whole business is designed, and our product suite is designed to lend capital to private companies here in the U.S. So absolutely what many people would constitute as the maybe middle marketplace overall. And with the change at SVB, no doubt it directionally moved more companies toward what we do. The thing about the banks in the U.S., regional banks included, is a while ago they made largely a decision not to really be lenders to these companies, these what might be considered sort of the smaller companies.
Yep.
And they made a decision a while ago not to be in that business. And even the biggest banks really are in the syndication business, right? They're in the business of intermediating loans. And so that already had been happening. It certainly accelerated further with SVB. And yet again, another reminder that at the end of the day, what you really want is long-term capital matched for long-term needs. That's what we do. We have capital that we have for the long term, so we can lend it for the long term. And it's happened time immemorial. When you take short-term capital and you try to do long-term things with it, at some point that ends up falling apart.
Speaking of falling apart, this growth in the private credit industry has not come without concerns and questions about the scope of this lending that is happening outside of the traditional bank system, especially in a rising interest rate environment. How do you address those types of concerns?
So look, whenever there's an emerging marketplace, it's worth asking those questions. So to be clear, they're perfectly sound questions. At the same time, I think often the critics, if you will, or the skeptics, say abstract kind of open-ended things like, well, you just don't know. Well, I mean, we just don't know if we live in a simulation either. So what we have to do is look at the facts. And the facts of the matter are pretty straightforward. We take capital, again, as I said, that we have tied up for the very long term. We make fundamental credit decisions with that capital, and we lend that capital to what we think are really great companies for the long term. And the evidence, however, is there that we know this model works. And that doesn't mean every single loan works for every single company. In fact, that would be a pretty poor result, right? We're supposed to be in a marketplace where there's a modicum of risk and return engaged. But take Blue Owl. We have lent $75 billion since inception. And you know what our loss rate has been? Annualized at 6 basis points. And in our software business, which is our biggest area, our specialty, we've never had a loss in one of those loans. Now, those are extraordinary numbers by the measure of direct lending. And of course, can't be lower than zero, so they can only increase. But they only have to increase moderately because we have very diverse portfolios with very good companies. So I certainly understand the question, but also importantly remember, because it's between us and our investors and the borrower, that's where it stops. So even if someone in this marketplace does a not particularly good job, first off, what you're talking about are having some challenges. Then, as a senior secured lender, you're the top of the stack. That is to say, you're the first one getting recovery. So then the question is, well, okay, do you get all of your money back or not? When you finish doing all that math and then realize it's not connected to the rest of the system, you don't have this cascade risk that others have, that you'd have in banking.
I guess it depends on who your investors are.
Well, it does. Our investors are extremely large pension funds, sovereign wealth funds, foundations and endowments, and then a large range. We've created access points for individual investors to participate. So this is a widely diversified pool of investors. And again, key point being, they're not guaranteed by anybody. It's not a deposit where the government has to step in.
So can I ask you, I want to ask you this question because banks are taking notice of what is happening in the private credit space, right? They want a piece of the action as well. Is a big bank friend or foe to you if they want a piece of that action?
So I would proffer that they're friends. And I appreciate that often the storyline is more banks versus the private lenders. But two observations. One, we certainly work closely with the banks. They've been critical partners of ours from day one and will continue to be. I would also say that for a vibrant economy, for a vibrant capital marketplace, it's not an or, it's and. Listen, this is a multi-trillion-dollar industry, right? This credit marketplace. we're small by that measure, not just Blue Owl, but Blue Owl and all of us taken together are a minority portion of that marketplace. So to have a vibrant marketplace and a vibrant economy and good capital formation, we need a really healthy syndicated market, bank-based market, and we need a really healthy private market. We've proven that too, because during the pandemic, during 2022, when the war broke out in Ukraine, during SVB, we were there providing capital. So we're providing capital at times when often the marketplace, the traditional marketplace, will not. So taken together, frankly, we've made the capital system, the banks plus the private lenders, that much more durable. That's a good thing.
All right. Mark, thanks for coming in. Mark Lipschultz, co-CEO of Blue Owl Capital. Appreciate your time this morning.
Thank you for having me. Deeply appreciate it.
Thanks. Take care. We got much more markets action coming up. You're watching Yahoo Finance. We've heard of Bidenomics, and now we have a new term for the Republican side, Maganomics. U.S. President Joe Biden, he touted his economic record during a speech in Maryland yesterday, and during it, he took aim at his rivals, citing the potential looming government shutdown.
Their plan, Maganomics, is more extreme than anything America's ever seen before. Just months ago, they went further than anyone has ever gone, threatening to default on the debt that's over 220 years old. Default, unless we gave them everything they wanted. The plan they're proposing never worked, but they decided to make it much, much worse. Now Republicans in Congress are doubling down with a plan that does three things. One, it cuts taxes even more for the very wealthy and big corporations. Two, it cuts Social Security, Medicare, and Medicaid. Three, it raises costs for families, gutting investments in the middle class. Only two presidents in American history with fewer jobs the day they left office than when they started. One was President Hoover, and the other was Donald Hoover Trump.
Well, on Thursday, we spoke with the White House's National Economic Council Deputy Director on the likelihood of a government shutdown. Bharad Ramamurthy explained the real-time impact on the administration and the economy.
The incentive to avoid a shutdown should be clear. It was highly disruptive to the functioning of the government. It jeopardizes things like disaster relief for areas that need government support right now. It jeopardizes support for things like cracking down on fentanyl trafficking. It jeopardizes support for funding for Ukraine, which is badly in need of that right now. So In addition to all of that, it causes disruptions for all the tens of thousands of government employees that live in the area and across the country. It leads to disruptions to things like national parks that American families rely upon. So there's all sorts of good reason to avoid a government shutdown. The president and the Senate, frankly, are all basically in alignment about what's necessary to avoid a shutdown. The issue is that, as has happened multiple times in the past, House Republicans are taking an extremist stance that's jeopardizing the basic functioning of government.
Well, Democrats are taking a new line of attack at the GOP, saying they're favoring big business and carving up the middle class with cuts to Social Security and Medicare. Let's bring in Yahoo Finance's senior columnist, Rick Newman. Hey, Rick, thanks again for joining us. So, Rick, partly new in terms of the angle, but will this new tactic attacking Maganomics work?
Probably depends on inflation, something President Biden can't control. So just so people know what Biden is talking about here, Maganomics obviously refers to Donald Trump, the Make America Great Again president, MAGA. But what Biden is actually referring to when he says the Maganomics plan is a budget plan for 2024 put out by a group in the House, group of Republicans called the Republican Study Group. So for anybody who really wants to know what Biden's talking about, you can find that on the internet, Republican Study Group budget for 2024. It's only 167 pages long, and I guess some group of poor staffers at the White House had to go through that thing and make all the comparisons to what Biden wants to do, which is where Biden gets those claims. But Biden, there's one thing that's not new about what he's saying now is he's been going around the country saying, look, here's what Bidenomics is, touting his plan, the green energy incentives. There's been a kind of a manufacturing revival underway, other things Biden has done. And he honestly is just not getting a lot of credit for voters from it. I mean, his approval rating has really not budged from the low 40% range, which is where it's been for most of the last year and a half. That's probably because of inflation. His approval rating went down in direct correlation to inflation going up in 2021 and 22. So inflation has come down, but Biden's approval rating has not gone up. And in many polls, voters say they trust Republicans more than Democrats on the economy, even though Biden's claims about the economy are generally true. We've had the most job creation since Biden took office under any president. I don't think he necessarily deserves credit for that. That's largely because of the recovery from the COVID downturn. But other things have been pretty good under Biden. The one thing that hasn't is inflation. And I think what Biden is hoping is that inflation really comes down and gets under control by this time next year when we're in the home stretch of the 2024 election. And the shock effect that many Americans feel from inflation fades, because that seems to be the thing that's holding back his approval rating for the time being. But he's going to keep trying. And the latest twist is let's compare Bidenomics to Maganomics.
Mm-hmm. Yes, it was interesting to see in the University of Michigan Consumer Sentiment Report today, inflation expectations coming down a little bit. So maybe that's some good news for the president. On the other side of the ledger, in terms of bad news potentially for the president, we should talk about Hunter Biden, of course, President Biden's son, being indicted on Thursday on gun charges. This story has been ongoing for quite a while now. How do we sort of process or read this latest twist, Rick?
It's actually just one gun charge, and he may end up charged for tax evasion in two counts of that. And these were all things that were supposed to be part of a plea deal that fell apart over the summer, which seemed like a big surprise to everybody. So the House is mounting these hearings, trying to, looking into what did Hunter Biden do? And most importantly, they're trying to link President Joe Biden to anything nefarious his son Hunter might have done. The grand total of things that we know, transgressions, let's say, that Hunter Biden is guilty of are twice he failed to pay taxes on a certain amount of foreign income. He has acknowledged that in the plea deal. And then he checked a box on a form when he bought a firearm saying he was not using illegal medication at the time. The gun charge here is not, he didn't shoot somebody. He didn't shoot up a classroom. He just checked a box that basically meant he lied on a government form. So if that is the whole thing that comes out about Hunter Biden during the next year, this could, potentially be a mild positive for Joe Biden, because it means he will undergo the scrutiny. Can anybody find anything he did wrong? And if the answer is no, Maybe by this time next year, voters feel like Biden is really the one being persecuted and his son, not President Trump, who claims persecution as he fights 91 criminal charges in 4 separate cases. The risk for Biden, I guess, is whether these investigations turn up something that actually makes him look worse than he does right now. And I think Republicans clearly are hoping for this. That did happen when they did the so-called Benghazi investigation of Hillary Clinton when she was Secretary of State. That did turn up a few things that Republicans were able to use against her when she ran for president in 2016. So they're hoping for a replay of that with Biden. I'm not sure they're going to find much, though.
We'll see. I don't know. How many boxes did Trump neglect to check? Rick. All right, Rick, thank you so much.
We can leave it there for now.
Yes, let's do that. Rick Newman, thank you. We're on the final day of our week-long special on student loans. The federal payments have been paused for the last 3 years due to the pandemic. Now, borrowers are about to start paying again beginning in October. The monthly student loan bill comes in at an average of $500, according to the Department of Education. That's a big chunk of change for any graduate, and it may have many seniors questioning, is a degree worth it? Here to explore that question and the options out there to navigate the world of debt is our next panel. Michael Learsh, Wells Fargo Head of Advice and Planning, and Linda Nicholas, Professional Studies Student Financial Services Director at NYU. Thank you guys both so much for being here. Linda, I want to start with you, because implicit in all of this discussion is how much debt you should be taking on in the first place when you go into college here. And so I wonder, how should people even be thinking about this? You know, it's the one kind of debt that, you can sort of get a student loan relatively easily.
Right, definitely. I think these are important questions that families are asking now when they're looking at the potential of taking on student loan debt, right? What's the long-term return on investment? And that's what folks are asking. What are the earning potentials for the degree track that I'm on? And when you're comparing colleges, I think this is where the conversation begins. Not just looking at the sticker price of a college, but comparing financial aid packages, looking at the institutional prestige there, the network that they have, the alumni network, and the job opportunities that exist. And there's so many great statistics students can look at, whether it's graduation rates at the colleges that are a great indicator of student success at those institutions, if it's the median income of their graduates, and the employment rate 6 months after graduation. And all these statistics are readily available on the U.S. Department of Education's college scorecard. So I definitely encourage all students to explore this, when you're looking at the investment you're making for your education.
So, Michael, I want to ask you this question. There used to be this kind of phrasing that said there's good debt and there's bad debt. Is student loan still good debt, if you will?
Well, when we think of what good debt means, you have to think about what is the purpose of the debt, just like if you were to borrow for buying a home, so a mortgage. And student loan debt is one of the most common debts outside of mortgages. And so we often think of that as an investment in our home, just like we should think of student loan debt as an investment in ourselves. So the real question to ask isn't whether it's good or bad debt, it's whether I can pay it back and whether it will be sustainable after I invest in myself. And sometimes there's this golden ticket effect that people have, right? Where they think they're going to invest in themselves, and then after they invest in themselves, they're going to somehow have this outsized earning potential. And I think we need to reframe that here in the United States of America. There's a lot of reasons to get an education and invest in yourself. Mm-hmm. Maybe 2 to really consider. One is you could change a career, or you could even have that career in the first place. The second is that you really give yourself that foundation to maybe get a graduate degree if you don't have one yet, or to invest in yourself in the workplace. So we really need to move away from that golden ticket effect and think of this as debt that we need to consider as sustainable. It's not good or bad, it is what it is, because if we want to get that foundation, we need to do it. And so we're investing in ourselves in a way that will give us that sustainability throughout our lifetimes.
And Linda, when we're trying to figure out that sustainability, I mean, with apologies to someone who works at NYU, are we also overvaluing certain institutions of learning here, the ones with the highest ticket?
Wonderful question, and I think it's great that families are starting to think more critically about the institutions that they're sending their children to. You're looking at the sticker price, but oftentimes we see that schools with a higher tuition sticker price offer more in terms of scholarships and financial aid than a lower or moderately priced institution. So I think it's easy to, pit different schools against one another, but I think that students, if they're interested in a program, if they see a program as a successful, well-known, reputable program, apply and then compare, the financial aid offer. So it's easy to get hung up on the sticker price, but the scholarships often vary greatly as well.
So, Michael, I want to ask you, give us 3 tips about how, because often people come into this without, this talk about talking to a financial advisor. Most kids are not, and the families who need this are not talking to a financial advisor. They're in it, right? They've already taken on the debt. And they're people who are about to, have to start repaying again. What would you prioritize in terms of dealing with this kind of debt, and and also how much debt one should take on?
So the first thing I would do is go to studentaid.gov. It literally has all the information one would need to consider whether they want to take on debt, including if you take on debt, there's required financial counseling ahead of time that describes interest rates to you, all the way to if you already have that debt, your repayment options. And there are income-driven repayment plans, for example, a new one called SAVE, S-A-V-E, that actually may lower your payment. So really the first tip, go to studentaid.gov and see what your options are. The second one is, when you think of what your minimum payment is going to be, potentially if you're starting to take on that debt or after you've taken it on, really find that out very discreetly. What is that minimum payment you are going to have, and compare that to the potential salary or the salary you have, and say, is there a match or a mismatch in a third tip or category, which is, what are my essential needs with respect to my income? Where do I need to pay for things? So we talked about a mortgage, we talked about rent, we talked about dependents, right? So family members that are depending on us to feed them, versus what's more discretionary. And when we think about things that are discretionary, I think a lot of times human beings confuse essential and discretionary items. And so with those discretionary items, how do we become much more intentional?
And Linda, just really quickly here, what changes do we need to see in this system?
Oh my goodness. Well, thankfully,
Sorry, we don't have a lot of time.
We don't have a lot, yeah.
The FAFSA is, experiencing this overhaul and simplification for the upcoming academic year, which we're really all excited to see how that reshapes the college financing landscape. So I think that's great. Anyone who's ever taken out a student loan knows that the system is Byzantine and complex, and we could definitely use some improvement there to help students navigate what's already a fraught process. So I'm hopeful we'll see more changes to come.
All right, great. To put a pin in it. Yes, very succinct. All right, thank you, Linda Nicholas from NYU and Michael Learsh from Wells Fargo. We appreciate both of you. We've got more of your market action ahead. Stay tuned. You are watching Yahoo Finance. According to multiple reports, Disney is in early talks to sell its ABC network and TV stations to local broadcaster Nexstar Media Group. This was first reported by Bloomberg. Now, media mogul Byron Allen also reportedly putting in an offer for an acquisition. Here with the details is Yahoo Finance's Alexandra Canal. Ali, I know you've been busy with this story coming out late yesterday. More developments overnight. Break it all down for us.
Well, you're right. 2 reports out there. One that Nexstar Media Group is interested. Byron Allen reportedly offered $10 billion for ABC, FX, National Geographic, as well as some of those local stations. But I want to emphasize that these are early stage talks. So nothing has been set in stone at this point. And Disney did offer a statement last night, writing, quote, "While we are open to considering a variety of strategic options for our linear businesses, at this time, the Walt Disney Company has made no decision with respect to the divestiture of ABC or any other property, and any report to that effect is unfounded." But I do think, guys, that this demonstrates how serious Bob Iger is about spinning off the linear networks. He said earlier this year that they are just not core to Disney's business at the current moment. We also heard from Nexstar at a media conference earlier this week, and they said they'd be very interested in purchasing some of those linear assets from Disney, but they did say that any deal would be complicated due to ESPN. ESPN seems to be the crown jewel of Disney right now. It shares a lot of its telecasts with ABC, so that could definitely complicate a deal down the line. In addition to the fact that linear networks, they are high margin businesses. It's profitable. It funds a lot of the growth initiatives that Disney is doing right now, especially on the streaming side of the business. So overall, just another example when we think about the decline of linear television, the disruption within that cable bundle, right on the heels of that Charter deal earlier this week. It seems like a lot of news has happened since then.
Yeah, indeed.
That was only Monday.
Yeah, it feels like I don't know when. All right, thanks so much, Ali. I'm sure there will be further developments, but hopefully you get a quiet weekend. Thanks so much. Well, coming up in the 11 a.m. hour, Rochelle Akuva is going to continue to cover the ongoing UAW strike and discuss the fallout of what it could mean for the automakers.
But before we go, Julie, I hear it's your last day on the morning show.
I didn't know that.
So it's something of an end of an era. We have a special message from a certain executive editor. If we, roll the tape.
Hey, Julie, your best friend here, Brian Sazzi. I'm at an undisclosed location and getting ready to do a big taping, but I heard you're moving into the afternoon show, and our executive producer, Alexander, asked me to come up with top 3 moments of doing the morning show with you. First of all, actually this feels really weird because you're really not going anywhere. You're just moving to a different time slot. But besides that, I'll give you one moment. It is working so closely with you and our head of news, Miles Udlin, during the pandemic. It was a really challenging time for all of us. We moved our entire operation essentially into our kitchens. And I think over that time span, we did some of the best work we've ever done in our careers. At least I know that I have. And I wouldn't be able to do that work. I wouldn't have been able to do that work without you, Miles, and our team really pulling together during a really challenging couple of years and making it happen. So thank you for everything on the morning show. Thank you for waking up very early to do these things. I can't wait to watch you and Josh Lipton crush it on the afternoon show and get through those tech earnings when they hit right after the close. Good luck with that one. I'll see you later.
Aww,
an earnest Brian Sazzi.
Yes,
wow,
that's beautiful.
That was totally unexpected.
Oh my gosh,
I'm not leaving, you
I know.
guys.
No, but it is like you have to
End
kind
of
of
an
mark
era,
this
I
moment.
guess.
Of course, you can't mark this moment without your partner in crime from mornings. Of course, we want to bring in the one, the only Brad Smith in
I'm not crying, you're crying. You're not going anywhere. This is so great.
It's so funny.
I guess I'll stand.
I know.
Should I do it at the interactive?
Right, exactly.
Congratulations,
You're part
Julie.
of that.
Can you chart it on the internet?
chart it,
I know exactly. We need some.
It's great that we do have the interactive because we've got a couple things loaded in. 3 things from the morning show that we will miss about Julie Hyman because we'll have to watch you in the afternoon now. But for what it's worth, we will miss all of you.
You do
Did I say for what? I said
that is a
it's
catchphrase.
worth.
That and putting a fine point in things. But Speaking of fine points, you're on point with your French pronunciations. We would not
The team does
last
enjoy
with,
that, I
with
have
all
to
of our
say.
guests en français without Julie. And also the Hyman Explainer. We've had so many and they've been spot on every single time. I remember watching you when I was sitting in the market intelligence desk at Nasdaq many, many moons ago, and to be able to just sit here with you every day, learn from you, and continue to see you in action literally feet away has been amazing. So we've actually got just a little bit more, just one moment to mention. Here's a clip of you, me, and Sazi, our partner in Prime. Well, it was us earlier this year. So he's really hoping that this Earth thing goes well for us in the near-term future.
I also hope this Earth thing goes well for us. I hope that we don't have to flee to Mars. I mean, I think Gates is making a good point here, right? Like, let's improve the planet that we're on before we give up on it and say we're going to have to go to Mars in 50 years.
I hear Olive Garden's opening on Mars, Julie. I'm very excited about that. I'm pumped.
That's not going to change my mind about wanting to go. Sorry.
Oh, all right, fine.
Space pasta, not in the cards for me. Thank you.
Julie's like, what is happening?
All right, I'm uncharacteristically speechless. So I don't know, guys. You know, you can watch me from 3 to 5. You can still watch Brad and Shauna from 9 to 11. It's going to be great all around. That's all I can say. Yahoo Finance, long live Yahoo Finance.
Congratulations on getting sleep back. Stay tuned
thanks.
for more Yahoo Finance.
Bye.
Welcome to Yahoo Finance. It's 11 a.m. on the East Coast, 8 a.m. on the West. I'm Rochelle Akufo. Here's what I'm watching this Friday. United Auto Workers makes history as the union goes on strike simultaneously against the big three automakers. 13,000 workers downed tools after leaders failed to reach agreement on a new contract. We're across that very big story. And this week saw the biggest names in technology and politics meet in a heated closed room session, talking all things AI. How big was it for the future of humanity? We'll take a closer look at where we go from here. Plus, the move higher in oil prices continues. Crude trading around 10-month highs, boosted this morning by stronger data out of the world's second biggest economy. We take a look at the impact of higher crude prices on the Fed. But first, let's take a look at how the major indices are faring. Seeing some selling off this morning. Currently, all three major indices at session lows. The Dow now off more than 210 points there. You're looking at the S&P 500 also down about 1% on the day. Tech-heavy Nasdaq taking the biggest blow so far, down 186 points or 1.3%. Let's also check in on the Treasury market as well, as we wonder how much of those higher crude prices will pressure the Fed. We're seeing the 5-year up about 0.6% on the day, the 10-year also up about 0.65%, they're steadily up, and we see the longest term 30-year yield, that's up about 0.4% on the day. Well, as the clock struck midnight on Thursday night, the United Auto Workers officially began their strike across all big three automakers using a new stand-up strike strategy. Now, this is the first time the union will strike against the big three since its 6-week strike against GM back in 2019. Well, joining us now to break it all down is David Underkoffler, Autolist Editor-in-Chief. Thank you for joining me this morning. And so, as we've mentioned here, this is a targeted strike that we're seeing at the moment here, but you know that Stellantis will feel this, at least initially feel the strike better, they'll fare better than Ford and GM. Break that down for us and how that might change if this does continue and more cities and locations join in.
Yeah, sure. So Stellantis, I think all of the big three automakers saw this coming. The contract, they all knew when the contract ended. But it seems like Stellantis was the most proactive and the most aggressive in building up a supply of vehicles. So that's Jeep, that's Dodge, that's Ram vehicles, particularly the Jeep Wrangler and the Jeep Gladiator. So they've spent the past few months throughout the summer. So they've got a pretty nice cushion right now for those vehicles. Ford and GM, their day supply, which is sort of how the industry measures how many vehicles there are to sell. Ford and GM, the day supply is certainly quite a bit lower. So they're going to feel the impacts of this strike most immediately.
And UAW President Shawn Fain has had some choice words, saying that these automakers have really not been negotiating in good faith. But then what is the strategy here in terms of doing the targeted approach versus a full walk-off? What are the pros and cons here?
Yeah, it's definitely a unique strategy. It's not one that they've seen before. That's sort of been Shawn Fain's MO ever since he was elected. He's pretty unconventional. He's pretty aggressive. So rather than, there's a couple of things that are different. For one, they're targeting all three automakers at the same time. Traditionally, they've targeted one automaker, like you mentioned, it was GM, and they've used the framework of that deal to then make deals with the other two. Right now, they're striking against all three. And they're also not having their entire workforce walk off the job at once. It's about 146,000 members of the UAW. Instead of that, they're being very specific, and they're choosing one plant for each of the three automakers. And those plants that they've chosen are pretty specific on why. And they're having just those workers walk off. So that's about 13,000 workers. It's a good strategy, the sort of targeted approach, because it keeps the automakers on their toes. Rather than having this contingency plan of knowing what to expect, they are not sure sort of day to day or week to week which plant is going to be offline. So that makes it harder. It makes more of an incentive for them to come to the table and negotiate with the auto workers. There is some downside. The union potentially could get in over their skis. Some of the factories could shut down that are affected sort of downstream. So you have a striking plant. If the closure at that striking plant affects a non-striking plant, the employees at that non-striking plant may be laid off or maybe on unemployment and unable to get money from the strike fund that the UAW has just for striking workers.
So then, David, I have to ask you, what does a realistic outcome look like? I mean, you note that in terms of the hourly labor cost average, currently around $65 under that Detroit contract right now. When you compare it to Tesla, $45, $55 for Asian automakers. And we're looking at some of these demands, seeing how far apart they are, and saying, some of these analysts saying that we might see, the Detroit contract have to double this pay. What does a realistic outcome look like when they're this far apart and the competition is paying so much less?
Yeah, that's a great question. I am no labor expert. I barely know what I'm having for lunch today. So far be it from me to guess sort of what's going to happen in the future. I do think there are some demands that's very clear that the automakers are saying these are non-starters. Bringing back the pensions for workers since the recession, that seems like it's a non-starter. Reducing the work week down to 32 hours, that seems like a non-starter with the automakers. I do think you're going to certainly see some pretty significant gains, both in cost of living adjustments and just general wage increases. I think that's where the two sides are certainly going to meet. Look, I wouldn't want to be in the position of the leaders of these automakers. They're in a really tough spot, like you pointed out. Their labor costs were already higher before this strike. They're going to be even higher than that. Most of their competitors, Tesla, a lot of the Asian automakers, their workforce is not unionized. So that's really going to eat into their margins of the big three. And then at the same time, the big three and all automakers are spending billions and billions of dollars sort of turning the ship around from internal combustion engines to fully electric. That's a lot of R&D costs. There's a lot of new plants for both assembly and for battery. So it's a really tough time for these big three CEOs.
Indeed. I mean, and the UAW tried unsuccessfully to unionize Tesla workers in California. But you have to wonder then, because a lot of people are saying, look, Tesla's going to be the big beneficiary of this. But if, the UAW is successful and they do get these, these compensation increases, what does that mean then? If you're a Tesla worker looking at some of these better compensation packages, and then also what does it mean for consumers? How are they going to see some of their pricing perhaps change?
Yeah, I can certainly see any wins that the UAW takes away from this current dispute. I can certainly see them sort of doubling down on not just Tesla workers and trying to unionize them. They've had efforts in other automakers' plants down, particularly in the South. I would imagine that they would try to take the gains they get from this dispute and apply that, maybe try another round of getting those plants to unionize. In terms of consumers, this is going to be sort of difficult to see in the near future. I do think Tesla stands to gain. I think there are some other automakers that have a decent supply, particularly with EVs. Nissan, a lot of the Korean automakers, that's Hyundai and Kia, they could potentially benefit. I think Honda and Toyota are brands that they also have thin supply, so maybe they're not going to pick up as many defectors from consumers. Look, if you're a consumer right now and you're potentially about to buy one of these cars from the big three, I would go to the dealership this weekend, especially for Ford and GM products. The Teamsters have said, as a measure of solidarity with the UAW, that they're not going to be delivering vehicles. So basically, it seems like whatever is on a Ford or GM lot right now is sort of what you're going to be able to get if it's one of those vehicles that is being built at the plant that is currently being struck. So I would act quick. I also think this is going to affect the used car market. If this pulls inventory off the new car market, if you're shopping for a new Chevy truck that's not being built anymore, potentially you go to the used market. Demand has been really high there for the past few years throughout the pandemic. I think that's going to push those prices higher too.
Indeed, because used car prices had been ticking down, but once you sort of see this scramble and potentially not seeing as much inventory, could be seeing that go back up. Appreciate you joining me this morning. David Underkoffler, Autolist Editor-in-Chief. Thank you and have a great weekend.
Thank you. You too.
Thank you. Well, markets moving to the downside as investors are reacting to the now ongoing UAW strike and look ahead to next week's FOMC meeting. Joining us for more on the latest market action is JJ Kinahan, IG North America CEO. Thank you for joining me this morning. So we're looking at an interesting picture, especially. You're very welcome. Compared to what we saw Thursday, you had a lot of this exuberance lifting the markets because of Arm's IPO. What are some of the realities that are setting back in this morning?
Yeah, it's kind of interesting, isn't it? After the best day we've had in 5 weeks, suddenly everything turns around quite the opposite way. I will say for the folks watching at home, the one thing to keep in mind that is good is, you have the S&P 500, the SPX up there right now, and trading 44.64. We should start to see some support here at 44.60. So at least there's an opportunity right here to stop the bleeding, if you will. And it's going to be a number a lot of us are watching for the end of the day to see if we can stop there. But I do think that, one of the big things that's going on is crude oil, over $90 a barrel. And this has kind of been largely ignored, in my opinion, by the market for the last couple of weeks as we've continued to march higher. You talk about inflation all the time on the show, et cetera, and there's nothing that quickly gets into people's pocketbooks faster than the price of crude oil through gasoline, et cetera. We look right now, the nationwide average for a gallon of gas is $3.87. A year ago, it was $3.70. And, there doesn't seem to really be anything that's sort of putting a top on this. So we really want to keep our eyes on that, because that's you combine that with the fact that credit card debt is at near its all-time high on rates that are significantly higher than they were a year ago. The consumer has been pretty solid. We did that University of Michigan survey this morning saying that people aren't quite as confident as they were even a month or two ago. And heading into the holiday season where people traditionally spend a lot more money, there's just a kind of lot of things coming together right now, combined with, as you just got done talking about, the strike on the automakers.
And JJ, why do you think markets are underestimating this? Is it that they just think this is a temporary blip? Because, we're seeing plenty of signs, especially with the oil market and Saudi Arabia, Iran potentially getting some of their money and their oil back online. So why do you think markets are being quite cavalier about this?
Well, I think part of it being because, let's face it, the employment at the end of the day is really one of the things that's helped significantly. The employment numbers have been pretty good overall. We had a lot of layoffs 6-9 months ago, and they don't seem to have really trickled through the economy, I think, in a way that many of us thought that they might through this summer. We still continue to see strong spending, et cetera. So I think that might be a really big part of it. I think the other thing that people are starting to pay attention to is, the Magnificent Seven or Elite Eight or however many of those NASDAQ stocks you want to say that have really sort of outperformed the market. Those stocks have been strong. Now, one of the other things that we didn't just talk about that I think is something people have to keep on the radar is the fact that the dollar has been incredibly strong overall. And, what does that really mean? Well, I think in this upcoming earnings season, what you're going to start to hear for really the first time in quite a while is that the cost for companies overseas to buy U.S. products is going to go up pretty significantly. And so with that, besides all the natural inflation, the strength of the dollar may be something, particularly on the tech side, that starts to weigh into sales overall. So if you're looking, beyond the next couple of trading days, and today is a really interesting day because it's triple witching day, that over the next few weeks as we head into earnings, that's the other thing I would definitely keep my eyes on.
And JJ, I also want to bring in the China angle here. Obviously, a lot of multinational companies have exposure to China, to their labor force, to their manufacturing as well. Been getting some sort of mixed data out of China as to how the economy is faring. What is your take on how investors should be viewing China and its impact on U.S. markets, being some of the data that we've recently now seen?
Yeah, obviously you have to fully pay attention to China again, particularly back to, you think about chip makers, et cetera. But one of the interesting things to me is you look at some of they had some decent numbers this morning out of China. But one of the interesting things to me about what's going on there overall is some of the government actions recently, trying to cut back rates, trying to, get people more fully employed, if you will. So they are an economy that's a little bit on the brink. I shouldn't say on the brink, they're not going away, but they are an economy that is certainly struggling at the moment, and the government is doing everything they can, so it seems, to get everything back online, to get people going again, to get that economy going again. But the real concern starts to come if you combine what's going on with inflationary pressures, and if they continue to slow, that may once again slow some of the sales that people have in China overall. And then the other end of that I think we have to be aware of is if some of the Chinese goods coming into the US, they just continue to slash prices, which could affect sales domestically in the US if China, wants to import more goods and slashes prices in order to do so.
Certainly would be interesting to see what that does for competition in the US. Appreciate you joining us this morning. JJ Kinahan, IG North America.
Have a great
CEO.
weekend.
Thank you so much. You too. All right, all your markets action ahead. Stay tuned. You're watching Yahoo Finance.
What story are investors not paying close enough attention to right now?
I think it's water, and we have a real scarcity of water, and it's only going to get worse as temperatures rise. Fresh water, water for industrial projects, water for municipalities, that's going to be a big issue. It's not going to be a big issue this year potentially, but going forward, I think that's one thing investors need to be paying attention to.
This week saw one of the largest congregations of the biggest names in technology and politics in a closed room session. Now that the likes of X's Elon Musk, Meta's Mark Zuckerberg, Microsoft's founder Bill Gates, Google's Sundar Pichai, and OpenAI's Sam Altman were in one room with US senators to influence potential regulations over the rapid developments in AI. Now, it marked a new initiative from the sluggish pace the US government has demonstrated to regulate and create structure in an industry which has many concerned about its impact on jobs, information, and security. And while these CEOs talked about both civilizational risks and new innovation, groups have critiqued the closed-door format of the meeting. Our next guest agrees with that criticism, thinking having only tech giants in these conversations is inherently flawed. Let's bring in our guest, Seeker CEO Pat Kondo, to discuss this more. Good to see you, Pat. So
how are you?
About, in terms of, good, thank you. In terms of who was in the room, what sort of a missed opportunity was that to just have it focus on the politicians and big tech?
Well, I think the most obvious thing is that at least 3 of the people in that room have been subject to DOJ antitrust law. So how can you have them in the room setting a policy or a standard with any credibility? So that struck me as right up front. And the second thing is that, you know, this country has spent trillions of dollars over the last 3 years trying to get small business back on their feet, yet there were no small businesses represented or no voice for small businesses, when I think AI is really primed to be able to help them, whether it's publishers, whether it's, you know, any type of small business that's out there. AI is, I think, their way of generating more revenue and cutting costs, and yet nobody spent any time talking about that either.
It's true. And I mean, this obviously is one of just the beginning of several conversations that they plan on having. But if ideally you were to sort of set this up, what would be a better way, given that this is really a societal move that we're all going to be involved in here with generative AI, being that, it's our data that's going to be out there?
Well, I think that there's, Europe is moving ahead they've been moving ahead of us with privacy laws. So certainly privacy of an individual has been stressed over the last few years, but has anyone talked about business data privacy? We know right now that many of the big generative AI companies on the West Coast have been looked at as violating policies by taking content from content creators, using it to train models without their knowledge or without their will or without any compensation. So you're getting a position where essentially they could learn somebody else's business and then create that business and take the very people they train data on out of business. And I think that's a real threat. It's happened before, and I think could happen again.
So then some of the proposals laid out, you have Chuck Schumer's plan, you had the potential, that blueprint, the AI Bill of Rights. Do you think that does enough to address all of these issues? I know that the White House's version was definitely more open when it came to sort of things like data privacy and some of the repercussions.
I think it's a start. I think that what you really want to avoid is stifling innovation. That's really the lifeblood of our country and where we're headed. And I think we have to balance the innovation and the slope of change and advancement against maybe some of the concerns people have, of which one concern again would be how synthetic content may change people's opinions in media or in the social media environment by influencing them ahead of an election or potentially influencing them through the education system. Again, those kind of things have to be addressed. There has to be guardrails, and the big companies that have distribution and have large volumes of users should really be vigilant, and that's where some of the policies should be focused on that aspect as well.
And Pat, of course, you mentioned, we have an election year coming up, and especially now that we have generative AI able to, have us have information out there that's not necessarily accurate, that does also include things like human bias as well. What are some of the ways that people can get some of that digital literacy and sort of recognize some of the signs and sort of perhaps hold some of their lawmakers to task, or their companies that they like to use, in really investing in transparency?
Well, so that's what Seeker does. We've built over the last 4 years, we've spent considerable capital building a filtering system that identifies where principles of journalism or cognitive biases kind of lead to less than credible information. And it's very simple. I mean, everybody is used to a scoring system. When you start school, you get a grade. When you go get a credit score, you have a grade. When you buy music, when you get a mortgage, everything is graded. So why can't the largest sources of content in the world be graded and be filtered and be measured? And we've built a system that can do that. And I think that's one of the best ways to prevent against what I would call illiteracy or digital media becoming a negative. It can actually improve critical thinking by highlighting these biases, highlighting these principles of journalism that were obviated by, for various reasons.
And that's exactly why you need more people in the conversation when you talk about generative AI, because those are some of the angles that really aren't being properly addressed. Appreciate you joining me this morning. Seeker CEO Pat Kondo, have a great weekend.
Yeah, thank you very much. Bye.
All right, let's do a check of the markets, sponsored by Tasty Trade. Off the session lows at the moment, but still deeply in the red here. The Dow currently off about 180 points, or about 0.5%. S&P 500, they're also down about 1% on the day as well. The tech-heavy Nasdaq there still in the deepest territory, off about 190 points, or 1.37%. All right, all your markets action still ahead. Stay tuned. You're watching Yahoo Finance. We're a little under a week away from the Fed's September meeting. With that in mind, interest rate traders largely believe the Fed will hold rates steady this month. You can see only 3% of interest rate traders predict a rate hike. But the November meeting is a different story. You can see more of a spread here, 30% of traders pricing in a rate hike. So then what are so-called Fed expectations across Wall Street? Yahoo Finance's Jared Blickery has those details for us. So Jared, what are we watching here?
Yes, Rochelle. As you point out, not much expected to happen next week in terms of the main rate, maybe in November, but even then it's only a 30% chance. But I want to show expectations of where the Fed's benchmark rate, the Fed funds rate, is going to be based on market participants' actions through the capital markets here, all the way through September of 2027. So this goes basically 4 years into the future. You can see there's a little tick up right here. So maybe the Fed is not done quite yet. Another 25, 50 basis points to go is the thinking there. But then we start turning down. So pricing in rate cuts starting in 2024. I have 3 lines on this chart. The orange line at the bottom is where we were at the end of July, and then the cyan is where we were at the end of August, and the purple one is where we are right about now. And as you can see, we started a couple months ago lower. So expectations have been shifting higher for fewer rate cuts because it only takes fewer rate cuts to get to this higher level right here. So this comes as a result of surprises in the economic data that we're getting that are largely beneficial to the economy, showing strength. And so this means we are seeing good news means good news for the economy, means good news for stocks and risk markets overall. This is a Citi Economic Surprise Index going all the way back 20 years to 2003. And we can see right here, we are at elevated levels versus history. You can see roughly this resistance line here, and we're a little bit off from that. But by and large, the economy has been not roaring, but has been not sputtering. It's basically been kind of a Goldilocks situation where traders think the Fed doesn't have to act too much, but at the same time, we don't see a recession coming. And all of this just means that if there is another recession coming or something develops that surprises traders to the downside there, we're going to have a big repricing of risk. The last chart here, this is a little bit separate, but this shows bank reserves. That's the purple line, and you can see how this pretty closely tracks the swings that we're seeing, the ebbs and flows in the S&P 500, which is the cyan line. But what you'll notice is the cyan line, the S&P 500, has climbed rather precipitously here over the last couple quarters, where we're seeing bank reserves just a little bit up, maybe flat. So just in terms of correlation, one wonders, is this gap going to be closed? Are reserves, in other words, that's kind of a bank proxy for risk, is that going to catch up to the S&P 500, or will the S&P 500 catch down to reserves? Something I think traders are going to have questions for Jay Powell next week is the reserve status, quantitative tightening. Where are we with that? We're almost to $8 trillion in bank reserves, not only bank reserves, but the Fed's total balance sheet. That is down from about $9.5 trillion. That is substantial, and that is a de facto drag on the economy. So I think there are going to be some pointed questions about that, but we'll have to wait and see what happens at 2:30 p.m. on Wednesday for that Powell taking the lectern moment, guys.
Indeed, certainly a lot for the Fed to have to consider before those announcements. Appreciate you, as always, our very own Jared Blickery. Well, if you're feeling thirsty, this Saturday marks the 188th Oktoberfest in Munich, Germany. Now, what started as a horse race in celebration of marriage between a prince and his princess is now an annual event drawing more than 7 million attendees, consuming nearly 2 million gallons of beer. Here with me now is the US CEO of Germany's #1 Oktoberfest beer, Steve Hauser of Pauliner. Welcome to the show. Looking at some of that
Thanks
footage
for
there,
having
very
me.
thirsty. So looking forward to this Oktoberfest. How will this year be different? What is going to draw people in?
Well, I don't think there's anything special needed to draw people to the Oktoberfest, right? It gets about 7 million visitors a year, give or take, depending on the weather. But certainly, people are excited. I know people in this country are excited. Everybody you talk to, it's on their bucket list, rightfully so. And we think this is the second year back from COVID. We think this year's going to be just as exciting and looking forward to it.
And Steve, people might not know, but this is a very select group who is able to serve at Oktoberfest. Talk about how your company was able to get in that pole position, that #1 spot here.
So we were present at the first Oktoberfest, the Paulaner Brewery and our sister brewery Hacker Shore. And over the years, the number of tents that we've been able to serve at, there's only 6 brewers, and you see them there on the visual. We have 6 tents within our 2 brand names, and we sell about 40% of all beer sold at the Oktoberfest each year. The tents are quite large, and it makes for quite a great time. The only beer that is sold, you see the golden lager there, the Oktoberfest beer. It is a seasonal brew. It is a classic lager, a little more robust, a little more with a little bit more impact of flavor, and a little bit higher in alcohol than is the normal lagers that U.S. beer drinkers are used to.
And Steve, you were kind enough to send me some here. So the one that you just saw on your screen there, the Paulaner Oktoberfest Marzen here. So have it here. I'm going to have a little taste here.
Now, so you're drinking the Marzen, which was served at the original Oktoberfest in the 1970s.
That's got some kick to it.
Yeah, that's actually a terrific brew. In the 1970s, the 6 brewers made a decision to serve a more golden style lager. That's an amber lager, and the reason why it's an amber lager, because at the first Oktoberfest you couldn't store beer because there was no refrigeration. So the beer was brewed in March and lagered until the celebrations in September. But it was a more robust brew to be able to retain its flavor through the lagering process.
And Steve, I do have two others to pick from here, but I do want to ask you that. So we have the Hacker, sure, the one that you mentioned there, as well as the Oktoberfest beer. So I have these 2 here, but I do want to ask you in terms of how your company fares outside of Oktoberfest. Obviously, Oktoberfest is like that's the big selling point. That's the celebration that gets everyone together. But how does the rest of the business do outside of Oktoberfest?
So thank you for asking that. So the beer business, as you know, is always interesting, if you will. This year, the total beer market is a little bit soft for a lot of different reasons, but our business is performing quite well. We're up about 11% this year, and we believe it's in part due to consumers are re-engaging with classic brewers and classic beers. So we sell a broad portfolio. We have a wheat beer, we have a lager, we have a pils, and they're all growing. And we believe it's because consumers, beer is really an affordable luxury, if you will, and consumers on the weekend want to treat themselves a little bit. $1 or $2 more a 6-pack for a better quality beer is something that they're quite happy to invest in.
I like that, an affordable luxury. Well, we wish you a wonderful Oktoberfest. Hope it is successful for you, and a pleasure having you on the show. Yeah, that does have a kick to it. Steve Hauser, thank you so much for joining me. Yes.
Enjoy it tonight after you're done. It's the weekend, so have a beer.
Thank you. I appreciate it. Take care.
Have a good day.
Thank you. All right, shifting gears now. Looking at shares of Planet Fitness, taking a dip there. Currently, as you can see, they're down almost 14%. That's after a leadership shakeup. Now, the company ousting its CEO, Chris Rondeau, who has been with the company for 30 years and has served as CEO since 2013. Now, the director of the board, writing in a statement, quote, "As we enter the next chapter of Planet Fitness's journey, the board felt that now was the right time to transition leadership." Now, Craig R. Benson, a current board member, has been appointed interim chief executive officer. Chris Rondeau will continue to serve on the board and in an advisory role under an existing agreement with the company. The company will conduct a search for a permanent CEO and will consider internal and external candidates. Now, Rondeau writing in a statement, quote, "I am grateful for and look forward to supporting the management team in an advisory capacity and have confidence in the long-term potential of Planet Fitness." For now, though, the stock under some pressure. All right, all your markets action ahead. Stay tuned. You're watching Yahoo Finance. Lennar, one of the nation's largest home builders, beat on its Q3 expectations on revenue and profit, announcing earnings yesterday. Now, given the company's scale and scope, it can give us a good read on housing demand as a whole, and it's indicating it is strong right now. Our very own Danny Romero is a Yahoo Finance reporter who's been following this and has been listening in on the earnings call as well this morning. Danny, what are your takeaways?
Rochelle, Lennar's earnings call is still underway. It's going on right now, but this is a home builder that focuses on selling after completion to really keep excess inventory low. The biggest highlights from the earnings results was the 37% gain on new home orders, which really signals the strong and solid demand in the new home market despite rising mortgage rates. The home builder also delivered more homes this quarter. That was an 8% gain there. But the quarterly starts pace, that remains pretty steady. In the third quarter, the quarterly starts pace finished at 4.9 homes. That's slightly lower than the previous quarter of 5.9 homes. That is something that I'm going to be paying really close attention to during the Q&A part, because that really is a good gauge on whether or not the home builder is building out more homes or are they just going through their backlog. Another thing to highlight was the average sales price of a home sat around $448,000. That's really hasn't really gone up. That's to meet the demand, the buyer demand, with affordable pricing, offering incentives. Order prices are down about 5% from last year. So that's really consistent with Lennar focusing on starts pace as well as their pricing. But Lennar is looking to end the year with a bang. They're expecting to deliver 68,000 to 70,000 new homes by the end of the year. And some Wall Street analysts are liking what they're hearing. They believe that Lennar will fulfill that guidance due to the fact that their cycle time has improved to 32 days, given the fact that they have found more labor. The supply chain constraints have eased to really provide support for that expectation that they're hoping to build.
Certainly some welcome news in terms of inventory there. So Danny, what about smaller home builders? How are they doing in this market?
Let's put it this way, that the bigger fish are really beating the market out there, just like Lennar. And the fact is that they have excess cash. Their stocks are rallying. They also have access to capital. Some of the small home builders are really dealing with a lender pullback. And that really impacts them when they want to take up some land, acquire land, and also construct some of those spec homes. That means a home without a buyer in mind. Another point to highlight, though, is that when a big home builder goes into a local market which is dominated by a smaller home builder, they are usually outbid. So that is something that's really impacting smaller home builders as well. But again, there's a boom that's going on in the home building market, especially for new homes. So these small home builders are still thriving off of that boom, Rochelle.
Well, I appreciate you getting us up to speed on that. Danny Romero, thanks so much. All right, all your markets action ahead. Stay tuned. You're watching Yahoo Finance.
What story are investors not paying close enough attention to right now?
I think it's water, and we have a real scarcity of water, and it's only going to get worse as temperatures rise, fresh water, water for industrial projects, water for municipalities. That's going to be a big issue. It's not going to be a big issue this year, potentially, but going forward, I think that's one thing investors need to be paying attention to.
Good morning. This is Yahoo Finance.
Big news, 3 things that you need to know.
We just got the announcement.
What happens now?
Now I got a question.
What does success look like?
What was one of the biggest challenges that you faced?
How much does that raise the odds for a recession?
This phase is over. Tell me what happens to the debt ceiling.
Where does generative AI, though, fit into your portfolio?
Talk to us about this diversification and what investors need to know.
And I think it's important. This is the stuff that gets me out of bed fired up.
What's the gateway? What's the new bridge to opportunity?
Doesn't matter if it's a soft landing or a hard landing.
Big interview. I can't wait.
Supreme Court out with the ruling on President Biden's student debt cancellation.
Right, let's turn now to some recent tech earnings.
And they give you information if you watch them closely.
President Bostic, President Investors, Gary Gensler, thank you so much.
Part of what Davos is about is sharing best practices, coming forward with ideas, and then enabling those ideas into action.
And I would add that there's more to come on this.
And we keep producing products that help people lead healthier lives.
This is one of those rooms they use to simulate light in space.
Interest rates will come down again.
Figure out where your money is going now. You gotta scope that out.
And the numbers really tell the story.
What does all this mean for you?
Keep it tuned into Yahoo Finance.
How do students get the best return on investment when it comes to results, reputation, and rewards after leaving college? Well, Princeton Review has ranked schools in terms of their best value overall to graduates, and we're about to hear who's coming out on top. Robert Franick is their editor-in-chief. Thank you so much for joining me this morning. So, I won't hold anyone up. Who came out on top here in terms of public and private schools?
Public and private. Public, of course, Georgia Tech has been in the spot before, but again, #1 spot for public schools, and then private schools. Not surprising, Michelle. I think we have mentioned it in the past. MIT. They're two glorious schools. They're tough to get into, but finances should not be a concern. Cost of college should not be a concern for students and their families once admitted.
So then when people are thinking of how to approach these schools in terms of how to get the best value, how should they be assessing it?
Well, a couple of different ways. I talked to a lot of students at Princeton Review. This sounds like a broken record on my side of the fence, but to do well in high school, to challenge yourself consistently, not only GPA, but the rigor of your courses, that's the first track, and that's always going to be primary. For not only academic admission, but for driving scholarship dollars as well. Cross that stream with SAT and ACT scores. A very close second would be AP scores. There's 38 AP exams, so there's lots of ways for students to distinguish themselves both in the classroom and then through standardized tests as well.
Because a lot of times people are just thinking, look, I just need to get into a school that I can afford, that perhaps gives me some good, perhaps alumni network to deal with afterwards. But as we start with what's most pressing for people, which tends to be financial aid, who came out on top there?
Well, when we think about financial aid, WashU in St. Louis, #1 on our best financial aid list. We have a couple of different ranking lists in that regard for Princeton Review because, as you say, it is so top of mind for students and parents. We have a survey at Princeton Review called College Hopes and Worries. The #1 survey for the past 7 years running has been concerned about assuming too much debt to pay for college. A very close second is that students will get into their first choice schools, but families won't be able to pay for it. So it's that giant umbrella of fear. But you're so right in thinking about finding a school that's the best fit for us. And then scholarship dollars should be awarded to students depending on the school based on their academic merit and, of course, their financial need as well.
And usually when people are thinking of their schools, they're not necessarily thinking about the longer term return on investment. What are some of the schools that have fared well in that regard, and how do you judge that?
Well, return on our investment, we look at career services overall, and there's been some usual suspects on this list, and this is kind of all over the list, from University of Florida to, of course, Northeastern had such a colossal year this past year, Clemson University as well. There are several different schools, but the way we look at it, we try to assess the career development and career resource centers that students will have, not just in their senior year in college, but from first year through senior year. So we're assessing internships, experiential learning, cooperative learning experiences. They all kind of mean the same thing. What are you doing outside the classroom to complement with your learning inside the classroom? And then will that vault you onto a career of substance upon graduation? And this list we came up with specifically because a father of a high schooler was going through the process a couple years ago and said, listen, can you help us to determine what's going to be the great return on our investment from a career perspective? And that's when we put in the list.
And I thought it was very interesting that 9 of the schools that you had on this list in terms of best value, tuition free. Is it that people aren't aware of some of these schools and they're sort of focused on some of the big names that they recognize?
They do, and to that point, when brand and perception of a school continue to play into the process of students finding a school that's going to be the right fit for them. But extend the lens just a little bit. I mean, there are 3,000 four-year colleges in the U.S. alone, certainly more than just the 8 Ivies or the 30 most competitive schools in the country. And many of those schools have great financial wherewithal, can have a great bang for your buck, including tuition-free schools. That includes all the 5 service academies, College of the Ozarks, lovingly called Hard Work U, because there's compulsory work on campus. But these are the great stories in college admissions that students should know about now when they're a freshman, sophomore, early junior year, so that they can put together a credible list and talk about finding fit with great substance.
And you raise a good point here. I mean, education itself is changing. I mean, AI has sort of added a new wrinkle into it, or perhaps a new opportunity, depending on whether you see it as a co-pilot here. How do you see that shaping perhaps the rankings and how people view a college education?
Well, I'm so glad that you brought it up. And AI, I'm seeing it in 2 different ways. One, from the college admission standpoint. We even have a new service out at Prince William, just talking about AI in college essays. And I'm loving this idea of instantaneous feedback for students. Admission officers are looking at the same thing. This great use of all of this data over time and trying to predict a class that's going to be diverse and academically glorious, and students that are going to profit not only their experience as undergraduates, but then their experience for their lifetime of their career. So those are the things that I think are important to watch, how students are using AI to get into school, and then how the schools are using AI to admit a wonderful class.
And Rob, just very quickly, for people who are wondering, they're looking at all this student loan debt. Yeah. If you had to sort of assess, is it worth it, given where the jobs of the future are headed and the sort of educational requirements?
Oh gosh, I'm so glad you brought it up. There is $1.7 trillion plus of outstanding student debt. I mean, we would literally be AI if we weren't a little concerned about that ballooning number. But the truth is, college is worth it for several different reasons. Students that have an undergraduate degree, opposed to a student that wouldn't have an undergraduate degree, will make $2+ million over their career lifetime. We hear that statistic all the time. But they also report lower rates of unemployment, throughout their career lifetime. Robert Wood Johnson put out a study a few years back that said students will live, or people will live longer if they have an undergraduate degree, because they're likely going to be assured better health care throughout their career lifetime. So there's any number of things, nimbleness in the jobs that they get to choose, in the markets they get to choose it in. So many benefits.
Well, there you go. So some longer term work that people should keep in mind there. Do appreciate having you on. Have a wonderful weekend. Rob Franick there. Thank you so much.
Thanks, my friend. Bye-bye.
All right, well, let's get you a final check of the markets. As we can see, still red across the board. As we can see, the Dow here off, still about 200 points there. The S&P also down about 39 points on the day. Tech-heavy Nasdaq still down by the most, by about 190 points. Stocks trading lower to end out the week. That does it for me. I'm Rochelle Oktoberfest, but I'll be back with you on Monday. I'll see you then.